keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
China has proven over and over again that it's willing to be anti-competitive, coercive, violate human rights, steal our technology, use it against us. And so the first thing you need to know is that we are taking it incredibly seriously, and we're going to be as tough as we need to be.
It's a different administration. It's the same message. That was Gina Raimondo there, U.S. Commerce Secretary from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Payrolls, 2 hours, 12 minutes away. Equity futures through 4,200, up 12 points on a session. We advance 1/3%. Euro dollar positive, a little more than 1/10, approaching 121 again at 120.84. Yields basically unchanged at 157.53. Your headline is in the commodity market. I should say your headlines are in the commodity market right now. Iron ore, all-time highs. Copper taking out a decade-long record high. We've had back-to-back weekly gains for crude, Tom. We've seen some big moves in this commodity market.
John, it's a rate of change. I'm glad you mentioned copper, and particularly London copper with some real depth there. I looked today, John, at the inflation-adjusted copper price back 30 years. We are right back to China boom highs. We are not back to the inflation-adjusted real copper peak of 2011, but it's shocking, John, how quickly we've gotten there. The rate of change right now with wheat with a jump condition overnight is just extraordinary.
Let's pick out your words carefully, though. The China boom. That was the previous cycle. This cycle?
Different.
Don't see that this time around. And if you look at the export-import data out of China this morning, exports were booming. Imports were decent too. But if you take a look at the copper imports, month on month, they were actually lower. Now, that's my big question for the super cycle commodity bulls right now, Lisa. Can that happen, develop, absent a China boom?
The difference this time around is the move to electric vehicles, the move to renewable energies, and that will be the push, the spending development across the Western world, frankly, in addition to everywhere else, that could potentially drive additional gains. Also, though, there is a question of shortages, John, that we're seeing across the board. How long do those persist? How do we get around that?
When it comes to the commodity market, as you know, Tom, the decisions made in the previous cycle shape the conditions for this one. And that's what's happened with metals and mining over the last 10 years.
I mean, John, we know you start with your Weetabix every morning here at Bloomberg. You have it flown in from our London office.
It's a protein shake.
It's all there.
I'll take a Weetabix now and then, Tom.
Yeah, I know. But, and I got to have my Raisin Bran, and, my father used to take the raisins out and steal them from me. It was torture. But, John, what's so important here, this isn't about domestic commodity consumption. This is mostly by part, the metals, which you mentioned, iron ore, et cetera, the recovery, and also this odd thing of feeding people where it's about cattle feed, hog feed, farrow feed. I mean, this stuff's important.
So on the ag side, I'm with you. On the metals side, the lack of a supply response is going to be a big issue here.
Yes.
You don't just dig a mine and start producing the output. That's not how this works. The supply response on the crude side might be a little bit more quicker, but even Goldman Sachs and Jeff Curry's pushed back against that it won't respond quickly enough. This is a demand shock, Tom. It's a demand shock, and that's what we're seeing in the price.
And the shock on a jobs Friday is a rate of change. Wednesday, Thursday, Friday is something. Let's go to the rate of change in Washington right now with Emily Wilkins. Emily, I've got to go to the voting rights story. Florida, Texas, Arizona with an audit, et cetera, et cetera. I'm confused. Who loses from vote restrictions? I'm seeing percolations that obviously Democrats and liberals lose, but even Republicans may lose from voting rights changes in the southern part of the nation in Ohio. Is that true?
Well, look at exactly what they're changing here, Tom. I mean, a number of these bigger restrictions, there are restrictions that would sort of impact mail-in voting. One of the ones that we're seeing go through the Texas legislature right now is basically saying that local officials cannot preemptively mail out absentee ballots, even to those who apply for them. Now, who voted by absentee ballots and mail-in ballots in the last election? It was mostly Democrats. We saw way more Republicans turn out the day of voting, and way more Democrats take advantage of those absentee ballots. You also see certain restrictions in urban areas, limiting the amount of polling places. Democrats say that's things that will impact their constituencies as well as minority voters. So Democrats are really making the case that this is going to impact them. This is going to impact their constituents. This is going to impact Black voters, Hispanic voters. Republicans, of course, at the same point say that, they're still adamant that there was fraud in the 2020 election that is not founded, that is not based in any evidence, but that is something that many Republicans still hold and that these legislatures say they are now trying to target.
Let's just sit on the position of the Republicans at the moment as it pertains to this payrolls report that comes out in a couple of hours' time. The South Carolina governor in the last 24 hours, Emily, saying the following: what was intended to be a short-term financial assistance for the vulnerable and displaced during the height of the pandemic has turned into a dangerous federal entitlement. There's been some pushback from Montana, from South Carolina. What's the position from the administration?
Well, to a certain extent, I mean, these governors can do what they want. President Biden does not have control over whether or not a state chooses or not chooses to accept something. But this does play into the larger feeling in Washington, D.C. about how big of a package is actually needed at this point when it comes to things like support. Interestingly enough, our economists say that one of the reasons that perhaps these states are seeing, these companies in these states are having difficulty hiring workers is because these workers aren't necessarily ready to go back yet. Schools might not be open. They might need to still be around and take care of their kids. They're not fully vaccinated. They're worried about their health and safety. And interestingly enough, those are issues that the Biden administration is trying to tackle with this next bill. They're offering those child tax care credits. They're trying to make it easier for child care to be there. There's sort of this give and take about what exactly is needed to get workers back to the workforce. These governors are betting that if they cut some of the unemployment benefits and incentivize people to get back to work, that will do the trick. In the Biden administration, they're taking a bit of a bigger picture look, looking at other factors that might be preventing people from going back to work.
Emily, good to catch up as always down in DC. Emily Wilkins there. Lisa, as you know, the focus here is the additional $300 in unemployment benefits that I believe expires in September. I imagine if they were going to put that program together today, given the data we're seeing in the outlook too, that program probably wouldn't expire in September.
Right. Here's the issue, though. There is a question of, do people decide not to get back into the labor force because they're getting an additional $300 a month that they, or a week, that they know will expire? Or will they look to get employment in order to lock in a job, that they're more concerned about long-term employment? The data is really mixed on this. I'm interested to know how much Joe Biden's going to address this directly when he gives a speech today at 11:30 a.m., John.
There are some questions I've got to ask the Secretary Walsh a little bit later this morning as well, Tom. It's a big topic.
Yeah, it is. I mean, I talked to Secretary Walsh about middle relief for the Red Sox. They're letting in 7 runs a game, which is outrageous for the former mayor of Boston.
Important questions.
It's a very important question. But, Marty Walsh has got some real questions to answer, John, because they're going to have to restructure policy out of this. Imagine if we get 900,000 last month, 1 million today, and 1.1 million next month. What do you do with that data stream?
Is it a feature or a bug?
Yeah.
I think that's important, Is it a feature or a bug? Do they want to keep this in place through September because it's going to force the employers to pay more to hire?
And Krosner wouldn't answer our question. As a former governor, he doesn't want to step on Powell. When's a trend a trend? That's a key thing.
Is it 1 report, 2 report, 3 reports, 4?
Kashkari will answer the question.
Not 2. I doubt it. Kashkari's going to join us a little bit later, though. Minneapolis Fed President Neil Kashkari with Michael McKee. 10 minutes after the payrolls report drops, as we count you down to that. Equity futures up 11 on the S&P. From New York City this morning, good morning. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Payrolls report 2 hours away. Going into that, equity futures look like this on the S&P 500. We advance 0.25% on the S&P, up about 11 points on the Nasdaq. We advance about 0.25% on the Russell by 0.7%. Want to get away from equities and get straight to the commodity market for you, because that is where your headlines are this morning. Copper, all-time high, taking out the peak of more than a decade ago. Now, here's the issue for me. It's not the Twin Peaks, it's the gap in between. The gap in between is what is shaping the conditions for this market. The decisions that were made over the last 10 years on the supply side. The miners, the big players, BHP, Rio, made the decision after the bust not to repeat the mistakes that they made previously, which is adding a ton of volume to iron ore, to copper, to all of these metals, all of these mining products. And because of that, what do we face now? A monster boom without the supply response, and without the plans to respond with supply anytime soon either, because of the discipline that may or may not stay around for commodities, for energy, for metals as well. And that's what's going to be interesting for me, Tom. How does the supply side respond to this story? And also, an additional piece to this too, this commodity rally is very, very different to what we saw 10 years ago, for a whole host of reasons, including, it does not include this time a big outlook for a monster China boom. That is not the story this time, Tom, and it's worth considering.
It is, and the chart is so important. For those of you in radio, it's a peak up in 2011. As John mentions, we come down to some reasonable flatness, and then it's truly, John, a moonshot as we come out of this pandemic over the last number of weeks.
Yep, and here's the curious piece on top of this. Switch out the board and get to the bond market. We've seen energy rip. Rallied again this week. We've seen the energy equities doing nicely as well. We've seen iron ore, all-time high. Copper, record high. Crude, back-to-back weekly gains. Yields lower on the week. This morning up about a basis point to 157. 30s at 224. But what have we seen this week? Energy do nicely. Banks ripping again this week. I have not seen high yields. I have not seen a steeper curve. Very, very curious what's going on in this bond market, Tom, given what's happening elsewhere.
I look at the real yield, folks, and it was a negative 0.90. It's a lesser negative, negative 0.88. And if I had to interpolate it, I'd get to negative 0.75 or even 0.70, given all the good news out there. And as John mentions, it is not happening. What is happening is we get informed. Carl Riccadonna joins us, Bloomberg Economics chief U.S. economist, on this historic jobs day. You know, it's a cliche, Carl. I say we go beneath the headline numbers. I don't know what the headline numbers is out of this pandemic, and I certainly don't know what's beneath it. What will you look for in the micro data this morning?
I think the
focus today has to be on, to make a little joke, string theory, as it relates back to Jay Powell's interpretation of events, because, he is very concerned about the economic scarring or potential economic scarring evident in the economy from what we've endured over the last 12 months. And the fact that 8.4 million workers who were employed back in January of 2020 are not employed today is really the fundamental driver of how we think about Fed policy and whatnot. So I'm not so concerned about the diffusion of job gains, so to speak, because we are seeing a decent breadth. The real focus is going to be if we're producing 1 million job gains or thereabouts this month, how many months can that go on? And until we're, see about 8 or 9 months like that, then it's still going to be the expectation that this is a very dovish leaning Fed.
Okay, aerospace guy, we've got cash carry coming up. We got way too much physics on the show this morning. Carl Riccadonna, you mentioned string theory, and within physics, it's quantum gravity. It's the drop that goes on within a drift equation. The gloom crew says the gravity is we're going to get back to something weak, tepid, or weaker than where we were before this pandemic. Do you frame real GDP in that negative tone?
I think we very much have to consider it in that capacity. We all know that GDP is going to be off the charts for the current quarter, possibly the next quarter as well, and there's some very artificial stimulants that will really make things look absolutely robust in the economy. We have to start looking beyond that stimulus high, and perhaps we got even just a little whiff of that this week with the ISM surveys coming off of their peaks. So maybe we've hit peak stimulus, or we're going to hit peak stimulus in the next month or two. And then we start this migration down towards the new normal for the economy, which I think is going to look a lot like the old normal for the economy. If we look what was driving the lack of wage pressures in the economy prior to the pandemic, we had very low unemployment, but thanks to things like globalization, automation, and risk from technology, and also low unionization rates among the labor force, there just wasn't a lot of bargaining power among workers. So there may be some now because there's such an acute shortage of workers, but I think that the tiger really hasn't changed its stripes once we get past all of this artificial stimulus that's propping up activity.
Carl, it sounds like in some ways it's easier to make a cycle call than a near-term call right now. Can you explain to me, and I know how hard you work, I know how hard all the economists on Wall Street work, how is it that you all look at the same data, yet we've got a lower 700K at the low end, and then we've got this wide range all the way out to 2.1 million. How do we end up with a range that wide?
Well, at economic turning points and really fluctuation points, so you see these kind of wide disparities of numbers. Ordinarily, the standard deviation on a payroll print might be plus or minus 80,000 or so. Now it's just this dramatically wide span, and so folks are looking at different data points. Some folks at large banks, for instance, have a lot of their internal data they can look at to see how credit card spending is going, what paycheck trends look like, and everyone's looking at unique data sets, but everyone largely has the same view of this very far above trend pace of growth. And the question is really if that turns out to be inflationary or not. I think that we do see kind of a transitory pickup in inflation, but if you look at what the market is pricing in, market participants, the collective wisdom of crowds is telling you that this will be short-term inflationary, not long-term inflationary.
And Carl, a lot of people take a look at the jobs deficit, as you were talking about, as a pointing to just how much ground we have to make up. And yet I think about the jobs deficit and how difficult it is to understand it because the economy has changed in the past 14 months. All of these jobs may not be coming back, or they may be coming back in a different way. How are you accounting for that? How big of an influence over your calculation is that?
Well, we can see from anywhere from lumber pricing to semiconductor pricing to labor market pricing, really, that there are kind of mismatches as an economy that is geared towards growing at about a 1.8 or 2% pace is hitting double-digit growth rates. So, of course, there are frictions as that occurs, and there's going to be mismatches in the labor market. I think we'll see evidence of that today and over the next several months here. But the truth serum for the economy is going to be once we get to, let's say, Labor Day of this year and the extended unemployment benefits start to expire and we get back to more a normal of a pace of growth, and then you'll have a better read of these underlying dynamics in the economy, and if we really won't be seeing those jobs coming back, and if workers really will have more bargaining power.
Carl, do you have any faith in any market economist truth serum of guesstimating Q3 or Q4? I'm not sure how you do it.
Well, I have less faith in the current environment because we have these very large variables.
Yeah,
First of all, there's the massive stimulus checks that rolled out in the March-April period. That's going to continue to prop up things like retail sales and other measures of activity. But in addition to that, we have some very large questions about what consumers are going to do about this mountain of savings they're sitting on and wealth appreciation that they have in both real estate and financial portfolios. We have to see how that plays out in the economy. Again, has the tiger changed its stripes? Are consumers more frugal now than they were 12 or 24 months ago? And I think as we get further and further away from the crisis, again, you see that things change subtly, but it's not a watershed change. But with those big variables, that could dramatically impact where we are in terms of growth this year. Again, my team is looking for about 7.7% growth in the economy. That's the fastest since 1983. Consensus is a little bit lower than that. So where we fall on that spectrum will really determine what economic conditions look like in 2022.
Just quickly, Carl, what's your number today?
We're about 995 on the number. So I think there's a little bit of an artificial momentum build we saw in March because of bad weather in February. So there was a weather effect that boosted the March number. And therefore, I think there might be a little less momentum than we really than first meets the eye.
Are we calling 995 gloomy, Tom?
It's a gloom.
Really?
I think Riccadonna's on the edge of gloom here.
Carl Riccadonna. Carl, it's good to see you. Carl Riccadonna there of Bloomberg Economics.
995,000.
One of those large variables that Carl was talking about just then, the savings rate, that has got to be the key variable right now for a lot of people for the outlook through the rest of this year. And Lisa, I think that the answer to that question at the moment, at least in terms of the estimates, they vary wildly when you ask economists what they think is going to happen with that pile of savings and the savings rate.
Well, Michelle Meyer over at Bank of America has done incredible work looking at the credit card returns and credit card spending data, and shows that people are really ratcheting up that spending. How much is that actually eating down the savings? The key question here, John, is who is doing the saving? Was it the higher income individuals who just weren't going on vacations and they have a lesser propensity to spend? Or is it the lower income individuals who will spend more? And that, I think, is hard to determine at this point.
And that is why we've got a wide range on a whole series of data points when it comes to the estimates. And we see that again today. 2.1 million at the high end over at Jefferies, 700K at the low end. And right slap bang, almost in the middle at the moment, your consensus, your median, 1 million. Just a beautiful round number, 1 million, going into the payrolls report, Tom, at about 8:30 Eastern.
Well, it's absolutely historic. Let's remind ourselves, folks, that a boom economy was 220,000 non-farm payrolls long ago and far away. If we got down to 150, we were frightened of the future, hoping to get back above 200,000, and here we are at a 5-times statistic.
Tom, I want to say you nailed it when you said it's
okay?
bearish. Well, no, you said that this is like, it's a disappointment or it's a lowballing figure. The idea, John, that 995,000 jobs is lowballing, I would argue is actually the sentiment across Wall Street, that if it's the consensus, that will be in some ways received as a downside surprise.
Which is why the likes of Steve Englander over at Standard Chartered thinks that we need a number north of 2 million maybe to recalibrate expectations around the Federal Reserve. Your equity market looks like this morning, up 11 on the S&P 500, up a quarter of 1%.
For an entry point.
Just waiting for you to say something, Tom, when you make those noises. 157.53. Then I just remember that sometimes you just talk and it doesn't make sense, and I just move on.
Are there any old cars back on the road?
Sure there are, Tom.
18 million units?
I know they're expensive. They're very expensive.
And they're more analog.
Do you want a second-hand car?
No, I got the Nash. I'm happy. I got a 1954 Nash.
Tom Keene is driven. 4205 on the S&P 500. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden stunned European allies and the drug-making industry with his support for waiving patent protection for coronavirus vaccines. That was a reversal of long-standing U.S. policy that its companies' intellectual property is sacrosanct. But there are signs the president is interested in a more modest compromise. Meanwhile, Germany has said it opposes a waiver. A warning from the Fed. The Fed says a rising appetite for risk is stretching valuations and creating vulnerabilities in the U.S. financial system. The central bank says prices could be vulnerable to significant declines if that appetite falls. Fed Governor Lael Brainard also cited the implosion of Archegos Capital and called for more hedge fund disclosures. JP Morgan CEO Jamie Dimon wants Congress to spell out targets for building roads, funding college degrees, and creating jobs. That's if lawmakers approve President Biden's massive spending measure. In an interview for the investment company Institute, Dimon said, quote, "Just throwing money, it doesn't work." He also said that if taxes are raised, there should be an itemized list of how the money will be used. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
really important to get the vaccine out there as quickly as possible. Now, a major impediment is access to intellectual property. There's an urgency here, and that's what the waiver is about. It's not changing the basic framework. There was always the right to compulsory licenses since that HIV/AIDS. The question is how to make it happen quickly, and that's what the temporary IP waiver is all about.
That is the view of the Nobel laureate Joseph Stiglitz there, Columbia University economics professor from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bramvitz, I'm Jonathan Ferro. Your market action on this Payrolls Friday, up 11 on the S&P 500. We advance 1/3 of 1%. Yields unchanged at 157.53. 8:30 Eastern Time. The payrolls report, the estimate on the headline number, 1 million. That is your median estimate. You just heard the words of Professor Stiglitz there. That is not the German position. Tom Keene, here's the quote from the German government. The limiting factor for the production of vaccines are manufacturing capacities and high quality standards, not the patents. The United States has one position. The allies over in Europe aren't completely on board.
To say the least, I thought it was really telling, and for this to come from the engineer and scientist, the chemist, Angela Merkel, John, was a huge deal and hugely symbolic.
You've seen what Mr. Gostin has said of Georgetown. There's more than a touch of hypocrisy in what the US is doing. It's been the world's #1 hoarder of vaccines. There are some people scratching their heads about this, Tom. If this is really about making sure capacity and supply reaches low and middle income countries, why aren't we focusing on something we can do really quickly, which is open up the exports of these vaccines and do something about these stockpiles in a much, much bigger way? Why are we focused on patent protection, which could take a long, long time to actually solve anything? And on top of that, why wasn't there a conversation with the allies before this was really pushed forward in a bigger way?
The conversation with the allies, to me, is really the key point, John. There got to be a joint effort here. This goes back to thalidomide in the 1950s, even the 1940s, and it seems the whole thing was done clumsy. John, help me translate these Pfizer, BioNTech headlines. What I see in there is the age 16. They seek vaccine approval for ages 16 and above.
They're looking for full approval of the vaccine. Right now, of course, it's under emergency use authorization along with J&J and Moderna. After the pandemic, after the crisis has essentially ended and we're out of this emergency mode, the full approval essentially allows a vaccine provider, the likes of Pfizer, BioNTech, to carry on rolling out those shots, Tom.
We've got the right guest at the right time. Andrew Pekos joins us from Johns Hopkins Bloomberg School of Public Health. He is a virologist. Dr. Pekos, I talked to Ofer Levy of the Children's Hospital in Boston about 10 days ago, and he was heated that a vaccine applied to an adult is different than the same vaccine applied to an adolescent, whether they're 17 and particularly on down towards 12 years old. Describe the challenge you have as a pro in a vaccine for someone 32 versus a vaccine for someone 15.
Well, much of the biology of the immune system is incredibly different and very much dependent upon age. Even simple factors such as dosing based on body mass are all factors that have to be empirically determined. And that's why you see these clinical trials now that are focusing on children that are breaking down the age groups into smaller and smaller groups. Remember, adults were basically 17 and above, right? Right now we're going in age increments of about 4 or 5 years or so because of the challenges that are produced by trying to move into those populations with the limited amount of data that we have so far. So very important to get this right, because children represent a population that could really help us move toward a herd immunity sort of endpoint. But the studies that should be coming out next week are going to be very important in terms of understanding the dosing and the side effects in those populations.
And just to sort of tie a bow on this, if we do get those 12 to 16-year-old guidelines next week as expected, how quickly could we see kids start to get vaccinated, and perhaps how much does that accelerate the path to full immunity?
I think you can see vaccinations start almost immediately because the vaccine right now is out there. As we've all sort of been seeing, the vaccine demand is starting to diminish a little bit. And if we look at the initial rollout of the vaccine, my guess is that there'll be a large bolus of individuals who are very willing and want to get the vaccine that will line up very quickly. So I think that the rollout into children initially will be very fast and very high, And then it's really just then going to be a question of sustaining it and getting it to a high percentage, running into similar problems that we see now with the adult population.
Andy, what do you think the biggest issue is underpinning hesitancy at the moment?
I really do think it's getting the information to people in a way that they are comfortable understanding it. From a scientific standpoint, I really am amazed at the wonderful data that's coming out about these vaccines almost on a weekly basis right now. So the data is there. Communicating it effectively to populations is what's really important. And of course, getting at the issue of equity in vaccines, finding the populations that don't have access to it, that haven't heard much about the benefits of the vaccine. Getting to those populations is going to be the really critical thing right now.
Dr. Pekosh, what do you think of New York City's decision to advocate for vaccine tourism, that basically if people come here to visit from other countries, they could get a vaccine and get first in line?
You know, more vaccinations are better, and everybody's trying to be, I think, creative about how to do this. You know, bringing someone into a country, vaccinating them, remember, your effect of the vaccine then takes several weeks before you can actually, you know, get the benefits of that. So the timing of some of these things is important. And again, we're allowed to do a lot when we're vaccinated, but we have to remember that it takes some time for a vaccine to actually get you your protection. And so that's, I think, the critical thing to remember as we roll out some of these policies that may allow for greater travel or greater access to vaccines for people who are non-residents.
Andy, it's good to catch up as always. Andrew Pekosh there, Johns Hopkins Bloomberg School of Public Health professor and virologist. Amazing that what was taboo just 2.5 months ago is now almost being discussed openly. Dare I say encouraged, Tom? Vaccine tourism. You remember 2.5 months ago, the head of Canada's big investment fund, the pension fund, had to step down. He had to resign because he'd gone to the UAE for a vaccine. That was 2.5 months ago. This story's moved quickly.
It's moving quickly, but John, to what you've been screaming about with, you know, battles in London and your travels, we make jokes about it, but it wasn't funny. And the answers, John, is we're right on the cusp of getting back to the process of getting back to normal. What I detect out there is a massive impatience. And people of all walks of life and whatever their story, they're like, let's go, let's go. And it comes down to you got to vaccinate 1 million people a day.
Well, for the airlines too. IAG this morning.
Brutal.
Debts get piling up, Lisa. They want the corridor between London and New York to open up. I feel like we've been talking about this now for a solid 9-10 months. Where's the plan?
Yeah, where is the consistency in the standards in terms of who is vaccinated and how we determine it? Dr. Pekosh, though, is dancing around a really interesting point. This question of, do we allow people in here who could potentially be infected? Do you open up the corridors to places from India, from Brazil, from South Africa, in order to allow people to get vaccine, in order to juice tourism? Is that going to be something that's more acceptable? I mean, these are serious questions.
Was he talking about other countries or other states?
I'm not sure what he's talking about, but this is an issue that we'll talk about.
Not really.
Do I need a vaccine passport to go below 59th Street?
No, Tom.
Okay, thank you.
This is Bloomberg.
renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Most forecasts suggest that at the end of this year, we will be better than we were projected to be before the pandemic.
We basically rebooted the global economy. We shut it down and turned it back on, and it's coming with a lot of messy frictions.
We should all recognize that the economy right now is experiencing a demand shock, the likes of which we haven't seen since World War II.
We need to not confuse a peaking in growth momentum with an end to very powerful growth.
The last thing in the world I really care about is that wages are going to explode. They are not.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up 0.2% on the S&P 500. The payrolls report 90 minutes away. Tom, the estimate well known at this point, 1 million.
Well, there's economics involved, and we'll cover that. Of course, Michael McKee speaking with the president of the Minneapolis Fed. You have Secretary Walsh later in the morning, John, on one of your other properties. I'm really interested in the market reaction and this delinkage that we see between boom commodities, good stock prices, really solid pricing, that recovery late in the day yesterday, and the oddities of the bond market. John, it's a true decoupling to me.
That's the market issue of the week so far. Energy equities up, bank equities rallying. We've seen the story in the commodity market, all-time highs on copper, big moves in crude, and then yields on a 10-year. 157. Yields lower, not higher. Well, the curve flatter, not steeper.
Liz Ann Saunders out on Twitter moments ago, the ace at Schwab, and she makes real clear it's across everything in debt. She notes a 30-year mortgage, 2.96%. I didn't realize that, John. I mean, you wonder why there's a housing boom. There's one reason.
There's a bit of tension there, Lisa. at the moment. And at the moment, we need to talk about a $120 billion QE program month after month after month after month. If you're wondering why the signal's not there in the bond market, maybe that's why.
And here's the question. Does any payrolls number actually matter if it doesn't signal a change in Fed stance? I mean, ultimately, is that the question? Is what will the Fed do? How will they interpret this number? Way more than anything fundamental about the economy, John.
That's the filter the data goes through almost immediately when we get that jobs report in 90 minutes' time. Your equity market looks like this, up 10 on the S&P 500. We advance through 4,200, 42.04, and up a quarter of 1%. I'll do it for you, Tom. Go to cash, 157.53. Yields unchanged on 10s.
What are we down?
Dollar,
1% from record highs?
70.
SPX?
We're not far off all-time highs on SPX, Tom. In the commodity market, crude just off a 65 handle at 64.78, up a little more than 1/10%. Record highs in copper, in iron ore. Pick your commodity, Lisa. Big moves.
Yeah, lumber as well, really to the moon. The idea here that you can't keep up with supplies quickly enough. And at what point is this transitory? At what point does this change? How much people are going to look to supply some of these industries? We've been talking about it all morning, 8:30 a.m., the big number, the payrolls report. Just to put it into perspective, it's not just these blowout numbers. We have a massive jobs deficit to overcome. The idea that 37% of leisure workers still have to come back into the workforce to get to where we were pre-pandemic. Just to put into perspective, these monster numbers trying to make up a monster gap. Then at 11:30 a.m., President Biden will be speaking about the jobs report. Key question to me is how much he addresses the claim that companies cannot hire workers fast enough. The idea that perhaps the stimulus that he injected into the economy earlier this year has helped keep people out of the labor force. How will he address that as he tries to get forward some of the infrastructure spending that he's played out? And then at 12:30 p.m., Treasury Secretary Janet Yellen, who I'm sure has learned her lesson and will not talk about interest rates in any capacity, will be joining Jen Psaki at the White House press briefing. It is interesting, though, to note also how she tries to frame up these incredible payrolls numbers that we're expecting with the need for further spending, how she talks about inflation, how she talks about wage pressure, because, John, ultimately, these are the issues that the Federal Reserve is looking at.
They are looking to control the narrative, that's for sure, when we get these boom numbers. The boom numbers we're expected to get at 8:30 Eastern. Tom, before we get there, what a lineup through this morning. We'll catch up with the Minneapolis Fed, Neil Kashkari, a little bit later this morning with Michael McKee. On the equity side, Savita Subramaniam of Bank of America, Morgan Stanley's Ellen Zentner, and Jeff Rosenberg, Tom, of BlackRock.
They're all great, and we've got a whole bunch of other people. James Glassman, I believe, stopping by as well. Priya with us in moments. I'm fascinated what Jeff Rosenberg says about the fixed income financial system.
Yields south of 160. Your equity market's still doing okay in commodities. It's just been wild, hasn't it? It's just been wild. And this week, we've seen massive moves in bank equities as well, up by more than 5% on the week on the S&P 500. And yields have been stable, if not lower. The curve has been flatter, not steeper.
Just equity markets, before we get to bonds here with Priya, John. Standard & Poor's year-to-date up 12%, Dow up 13%, NASDAQ 100 a horrific lag up 6%. I think that's a double-digit market.
Energy equities up almost 40%.
Thank you. Glad you mentioned that.
Wow.
I'm not in them. I'm in the triple leveraged non-energy fund.
Clearly not. Priya Misra joins us now, TD Securities Global Head of Rate Strategy. Priya, you heard a little bit of the conversation there. I think it's a debate you've probably had with your clients too. We all want to get back to normal, all racing back to normality, so to speak, for a lot of people, especially here in New York City. And the question's just the same. Why aren't yields higher? Why aren't yields higher? Why aren't yields higher?
There's just one answer to it. It's the Fed. And it's the fact that we're getting all this very strong data, but you can't extrapolate. And the Fed keeps telling us we were expecting this boost in economic data, but you know the fact is that the Fed doesn't believe that it's that or doesn't know how substantially long will it last, which is why I think the Fed is telling us, well, we're still very far away from our goals. And if the front end is that pinned, and if the Fed continues to buy the $120 billion every month, they're containing the entire yield curve. I think if you decompose 10-year treasuries, it's really real rates that have declined. I think that's what's telling you that the rates market market has heard the Fed, has heard this extremely dovish reaction function. But now it's all going to be about the data after this reopening related boost. So what is the data? I'll say the data is important, but it's really the data not right now. It's going to be the data in August, September, when we can say that the reopening is behind us.
Priya, I say this with immense respect because I think you've got one of the toughest jobs on Wall Street right now doing full faith and credit. If I look at full faith and credit sovereign, frankly, worldwide, but let's focus on the United States. Clearly, we've identified on the show a decoupling. Does it go back to the complete mystery, as you mentioned, months from now within the ISLM framework, the classic Hicksian framework, which we don't know real economy from financial economy, and we can't price it?
Well, I think, at some point, the Fed is going to take a step back. They've told us they'll signal well in advance. That doesn't give me a lot of comfort because the market will react when that signal comes in. As we have to find out the market clearing price of interest rates, of every risk asset, I think that's when the tension will come in. The market liquidity, I would argue, is not today the way it was back in 2013 when we had the taper tantrum. Can we get a repeat of the taper tantrum? When we have to actually figure out who's the marginal buyer of treasuries. Our deficit's very, very high, and it's going to stay high next year as well.
And Lisa, what's so important there is Priya talks like a grizzled pro, where yield is price. We talk about the price of yield, the indication it gives to the market, and right now it's nuts.
It's nuts because people are expecting a taper tantrum, Priya, like you say. But how do you prepare for it when the Fed is pinning the market? Which raises a question, how significant could a tantrum be? You have equity traders already trying to game out how they're going to get ahead. Leon Cooperman talking about finding the exit, being prepared. And yet bond traders seem to be pretty set in where yields are now, faith in the Fed. If things do change, if we get a hawkish surprise at the August symposium off in Jackson Hole, like some people are expecting, how violent could this move be?
So it is going to depend on the messaging. I hope the Fed has learned from 2013. So they pre-message, and then they tell us that it's going to be a really gradual taper. If that communication is not there, and that the hike is much beyond that tapering, if they're able to message that the exit will be gradual, there's a lot of steps to do before they can hike, I think they can prevent as violent a repricing. Also, I think it's going to depend how the market is at that point. We have a lot of supply. Next week, the auctions start again. So as the market has to take down auction after auction, I think actually real rates are going to start to head higher. So if we enter that Jackson Hole or September FOMC with rates higher, with some repricing having done, then you don't need as much of that move to sort of find that marginal buyer of treasuries.
Priya, just before you go, just quickly, what's the balance of risks around this payrolls report at 8:30? That's really what we're trying to get at this morning. Is there some asymmetric risk there? Do we respond more to a downside surprise than an upside surprise? What's your take on that?
Yeah, good point. I actually think the market is expecting a good number. So I think we'll get that asymmetric. If you get a weak number, particularly if it shows that the recovery is not inclusive, it's going to push the Fed exit even further out in the market's mind. And, I think everyone's looking for a good number. So I think a weak number will get a bigger reaction in risk assets as well as in treasuries.
The take of Priya Misra of TD. Priya, thank you. The head of rates strategy over at TD Securities. Right now, your 10-year, 157, Tom. Your 2-year, 15 basis points.
Yeah, we're jumping back and
anywhere.
forth. We're jumping back and forth. What we call nominal, the current yield versus inflation-adjusted yield. And there's a lot of moving parts there, John. And what's interesting is all three parts are a mystery right now.
Well, let's focus on the nominal just right now, Tom.
Okay, nominal.
So my issue at the moment, and my question for the last several weeks, several months for that matter, how big does the data need to be to get that 2-year to respond? That's really what Steve Englander of Standard Chartered is getting at here.
Absolutely.
Thinks you need something north of 2 million to really get people to recalibrate Fed expectations. And for all the talk of a credibility test, that's where it's going to show up on the yield curve. That's where it will show up.
And we saw it with Randall Krosner, the former governor. We're going to see it with Neil Kashkari. These people don't want to talk about string theory, about moving averages. They don't want to get out front of where Chairman Powell and his really serious responsibilities are.
Chairman Powell's response to a lot of this, Lisa, is we've only had one payrolls report. Of course, we've had a lot more data than that.
But what Priya said is really telling, that basically bad news is good news. I mean, not to go back to that narrative, but yet that is what we may see if there is a disappointment. You'll see bond yields come down, price up, and then you'll see also equity assets rally because the faith in the Fed gets reaffirmed that they're going to go longer out. It raises a question, though, to me about financial stability that the Fed is clearly worried about, John, and it raises questions about how much more froth we build into markets.
So the story you just mentioned, I think a lot of people will be with you. Where I have a little bit more uncertainty is around the equity piece. If you think about what rallied this week, the financials, the energy players too, if you had a downside surprise and put some doubt into how big the demand was right now, I'm not sure that would be supportive of what's rallied so far this week going into that number.
No, but you could get a rally in big tech. You could get a rally in some of the other laggards that frankly made up the bulk of the gains that we've seen over the past 3 years.
Yep, which of course is a bigger weighting in the S&P 500 overall. Coming up on the equity market, 8 a.m. Eastern Time, Savita Subramaniam of Bank of America Securities, head of U.S. equity and derivative quantitative strategy from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV on his Payrolls Friday. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Economists expect a sign today that fewer business restrictions are bringing more Americans back to work. The April jobs report is out at 8:30 a.m. New York time. It's likely to show that the economy added about 1 million jobs last month. Our survey also shows the jobless rate probably fell 0.2 percentage point to 5.8%. And a new report from the Fed warns that investors are gorging on risk, and that could lead to stretched valuations and vulnerabilities in the U.S. financial system. Fed Governor Lael Brainard also says the impact of the Archegos capital implosion shows that more hedge fund disclosure is needed. And a petition demanding that the Tokyo Olympics be cancelled gained support in Japan. The government today extended the state of emergency in the city and beyond to control the spread of the coronavirus. Prime Minister Yoshihide Suga has been determined to press ahead with the Tokyo Games. Polls show most Japanese voters want them cancelled or delayed. And in China, exports rose more than expected last month because of growing global demand, and imports jumped on surging commodity prices. Exports grew 32% in dollar terms from a year ago, and imports were up 43%. Shares of Adidas are rising. The German sports shoe company raised its sales forecast due to a rebound in China and online sales. It predicts that second quarter revenue growth will hit 50%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every single thing, from the deck of an aircraft carrier to a railing in a new building, is going to be built by an American company, American workers, American supply chain, so that we invest American tax dollars in American workers.
The President of the United States, sometimes in Washington, it's far more interesting looking at the similarities between the two parties than the differences. And Buy America is where there's some real crossover. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro, live on TV and radio, going into a payrolls report, 1 hour, 12 minutes away, up 10 on the S&P. We advance 0.25%. Yields unchanged at 157. Euro dollar, just a little bit of a stronger euro in the mix here at 120.74. In the commodity market, all-time highs in base metals for copper. 65, just south of that on WTI, 64.79. We appreciate their advance. Travel north by a little more than 0.1% on WTI. But Buy America, Tom, in the payrolls report, when we get that at 8:30, American workers, how many times have we seen that in a press release from this administration?
Well, let's go there right now. As the president mentions repeatedly, American workers, and then with it, leading the zeitgeist this morning, are American unemployed. Mario Parker joins our White House reporter. Mario, I get American workers. Is a progressive element of the Democratic Party on board with their president that we need to jumpstart American workers?
Yes, absolutely, Tom. In fact, the progressive part of the party is keeping the fire under President Biden to rework some of the social safety nets as part of his legislation, right? So he's got the infrastructure, the traditional bridges, roads, et cetera, but they're also making the case that people are infrastructure as well. And that's causing a little bit of tension, of course, as you would imagine, with Republicans who would like it to be traditional.
But this is the nuance, Mario. You're very good at this. It's not just the Republican tension, it's the moderate Democratic Party tension. I mean, there's a conflation since Bill Clinton of is it welfare or is it social aid, whatever you want to call it. But we almost got a Democratic Party talking out of both sides of their mouth.
Absolutely, and that's what makes it very tough for President Biden. Not only does he have to contend with Republican opposition, but he's got to keep his caucus together. We saw that he barely was able to do that with the COVID relief package earlier this year. These infrastructure bills are going to be a tougher lift for him. We're seeing, tension with Senator Manchin, other moderate Democrats as well.
How important, Mario, is today's unemployment number, an employment number rather than unemployment number, going to be for Joe Biden and how he tries to get fellow Democrats and fellow Republicans on board?
it's fascinating, right? Because we're expecting unemployment to fall, and that's something that usually a president would want to come out and tout. But if you tout that too much, then it kind of dampens the argument as to why you need $4 trillion in additional spending, right? So he's got this delicate dance that's really rare because he's got to tout the number and say that he's made progress, but at the same time make the compelling case to the American people as to why there needs to be improvements as well.
Mario, it's interesting that there have been a lot of rumors about him possibly replacing some of the top members of the Federal Reserve at a time when the Fed seems to be adopting policies that absolutely support his efforts to continue to spend. Can you talk a little bit about what the thinking is in Washington as to why Biden would inject a changing of the guards into markets right now?
Well, as you alluded to earlier this week, senior advisor Jared Bernstein kind of demurred, and it kind of shook people up here in Washington when on the question as to whether or not Biden would support Jay Powell for another term. The Biden administration has said that they want Federal Reserve Board seats. They want other places of the government to be more reflective of the country. They want to put an emphasis on diversity. So that's been the primary argument as to their Fed board appointments or any other administration appointments.
Mario, do your colleagues in crime in Washington expect many states or a few states to join Montana and South Carolina in saying enough to this government aid, keeping people off the payroll? What's that trend as we go into the weekend?
No, that is something that's causing concern for the Biden administration, right? We saw something similar, in terms of when he was Vice President Biden under the Obama administration. So that's something in concern of utmost concern to the Biden administration as well.
Right now, when we talk about the agenda, we've been talking also about China and how Joe Biden has taken a very similar tactic to former President Trump when it comes to the restrictions on that nation. Can you talk about any further actions that you're expecting in upcoming months that could potentially either build on what President Trump did or perhaps take a slightly different tone?
No, that's a really good point, because we have said that's exactly where we say some similarities between both the current president and the former president. It's kind of this hardline stance. Of course, we broke the story yesterday that President Biden is going to keep in place some of the trade restrictions with China as well. His speech yesterday in Louisiana, he made the case that this infrastructure package is necessary in order to compete with China. I think he used the phrase, "China is eating our lunch." These are some of the signals that President Trump used as well to kind of stoke American competitiveness and also to take a hard line against China.
Mario, always great to catch up with you, sir. Come back soon. Let's catch up next week. Have a good weekend, Mario. Mario Parker there, our Bloomberg White House reporter. Just going through some of the similarities between the two parties right now. China just being one, Buy America connected to that, a second piece of it. Where the differences are, though, on the labor market gets a little bit more compelling, doesn't it? Some tension there, Tom, between the governors, Republican governors of South Carolina, of Montana, on the additional unemployment benefits that they are pretty forcefully saying is holding back the labor market from recovering as we work our way through this boom.
John, this goes back to something I've had tons of mail on over tons of years, and that is you can't have the same unemployment benefit for Brooklyn, New York, that you have for Brooklyn, Tennessee. I mean, the standard of livings are just different, and I've never heard a good explanation of how you solve that. I don't think it's surprising it's Montana and South Carolina, and off the top of my head, there's 20 other states where that's a lot of money. That benefit is a lot of money, given the average labor salary.
They were the complaints through the whole relief package, Tom. There were some of the complaints in the last package as well, that maybe some of this should have been mean tested, it should have been different in different states. The problem is, once you start doing that, you really start to hit the pace, hit the speed of the rollout.
I mean, I mean, John, is it a big weekly supplement in Queens, New York?
Clearly not, compared to maybe some other states. Tom, for Neil Kashkari, the Minneapolis Fed, do you know what he's going to say? Because I've heard him say it before. He will say, if you want the workers paying more, they'll come.
Yeah, well, I happen to be in his camp, but he's going to be careful what he says with our Michael McKee after Secretary Yellen set up a clinic there on what not to say.
I'm not sure that Mr. Kashkari's ever held back. Lisa, do you expect him to hold back a little bit later?
No, I don't. And I will also just add to the conversation about wages. It's very hard to come to a conclusion about what influence this extra stimulus payment actually had. Because frankly, when you talk to economists, it is a mystery. The frictions are incredibly complicated.
Totally.
Getting workers back on board, it is very difficult to make some sort of broad-based conclusion.
Just an example, though, of the political tension over these big economic issues at the moment.
That's the conclusion.
Coming up, Ellen Zedner, Morgan Stanley chief U.S. economist. Futures up 8, we advance 0.2% for our audience worldwide on this Payrolls Friday on TV and radio. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The payrolls report 60 minutes away. Going into it, At 7:30 Eastern, here's the price action. Up 8 on the S&P 500. We advanced there 0.2%. On the Nasdaq, up about 1/4%. On a Russell, by 0.5%. The story over the last week, switch up the board and we'll take a little look at it. It's got to be the banks for me, not energy. We've talked a lot about what's happened with energy. The banks on the week, over the last week this is, up by more than 4%. And this has happened as the curve has got flatter, not steeper, as yields have come lower, not higher. Your 2s, 10s over the last week is narrower, tighter by about 5 basis points to about 141. It's kind of the mystery at the moment. Why have banks continued doing what they're doing as yields and the curve has done what it's done? Switch at the board and get to this as well. Yields have been lower, not higher, the curve flatter, not steeper, even as we've seen this continuation of the commodity rally. Copper up by 33.9% year to date. Copper futures there, Tom. I didn't do that, by the way. Let's be clear about that. That is not the LME price, which has gone through a new all-time high earlier this morning. Crude up by 33.49% on WTI to 64.77. Tom, it's a little bit of a mystery this week, isn't it? The tension can last, of course, but there is some tension there that we should talk about.
I'm speechless, John. I think we need to shoot somebody. They put up Chicago copper instead of
I'm not sure who did that.
LME. It's a massive failure of our system.
Let's avoid death threats.
Well, it's not a death threat. It's just a pharaoh threat, which is different than a death threat.
John, can I clean that up?
Please go ahead.
That Tom has a very different approach than maybe I do. Just want to make sure that's on the record.
The rate of change here of me going out the door. No, the rate of change here, John, is extraordinary in commodities. It's a story buried by the jobs news today.
Yeah, and I think it's part of the reflation story. But to see nominal yields so stable as inflation expectations break out, as real yields drop lower, and we've not seen the corresponding rally in big tech. Romain's going to touch on that in a moment, Lisa. Big tech has just really struggled. The stay-at-home stocks have really struggled for obvious reasons. I would have just expected a little bit more support from real yields for other parts of the equity market.
It's difficult for me to correlate the fact that bond markets are not getting the same message as stock markets, which are expecting a more hawkish Fed.
Maybe it's a bit of QE, all $120 billion a month of it. Maybe it's that.
Perhaps.
You like the line from Governor Brainerd, if risk appetite drops, you might have a disruption in the force.
If water is wet.
But it's risk appetite, and what shapes risk appetite?
This is the most philosophical
Federal
jobs day
Reserve?
I've ever.
Payrolls report, 60 minutes away. Some big moves to talk about. Here's Romain Bostic for more. Hey, Romain.
Yeah, the market in a little bit of a holding pattern. Of course, as we wait that payrolls report, S&P futures up about 9 here. As far as some of the individual movers here, DraftKings earnings crossing the wire. It was actually pretty good, and they actually did raise their revenue forecast here for the year, with the low end of that forecast pretty much right around consensus estimates. But right now, the shares flat here in the pre-market. The biggest decliner here pre-market is Appian. That's the software company here. They reported earnings, and it really disappointed pretty much across the board here. Shares down 16% pre-market. The biggest gainer pre-market, that belongs to Roku. They reported earnings last night, and it pretty much knocked it out of the park. The Street was actually looking for a GAAP loss. The company reporting GAAP net income and providing a forecast that was well above most Wall Street estimates. Flip up the board here, because we know every company has to deal with competition, but when you wake up one day and find out that your competition is Walmart, you tend to get a little bit of skittish here. Teladoc shares down 2.5%. This apparently off the news that Walmart is buying the smaller competitor called MeMD. It's basically a telehealth care provider here. So Walmart pushing deeper into this telehealth space. We know Amazon has also done that. You've seen the interesting reaction here in the shares of Teladoc, GoodRx, and some of the other companies that specialize in this. It'll be interesting to see whether they can all sort of coexist in that environment. CureVac and a lot of the vaccine stocks getting a little bit of a boost here. This following I guess Angela Merkel and a few other countries sort of pushing back on the White House's attempt to sort of put this waiver out there for COVID-19 patent protections. CureVac shares up about 10% here pre-market. And finally, Square shares up 2%. They did report earnings last night. Cash App, that's really all it's about. Bitcoin, that's also what it's about, Tom. That's right now driving that company right now.
Romain Bostic, thank you so much. We'll look at equities here this afternoon, of course, after all of this economics this morning. Ellen Zentner joins us right now, and what she knows from her econometrics at Colorado is it is about physics envy. That's been true of economics back to the 19th century. And what we see right now is the inertial force of moving from a pandemic 14% unemployment rate down to maybe under 6% unemployment rate and onward and forward. Ellen, what's the inertial force right now of this trend in unemployment? How strong is the oomph to get back to, say, 4% unemployment?
Well, I think right now, Tom, if we find out later this morning that we move into this realm of million-plus jobs each month, at least for a time, then we're going to continue to drive the unemployment rate lower, and it's going to continue to be one of the fastest labor market recoveries that we've seen. But what really matters here is what happens with the labor force participation rates. You can get that unemployment rate lower very quickly if a lot of people have dropped out of the labor market altogether. It has to do with how we calculate unemployment. And so what we want to see is unemployment rate continues to come down, but not necessarily so quickly because we're bringing a lot of people back into the labor force. And I think that's the important underlying detail that we'll be looking for in each monthly report.
Alan, how much patience do you think we need to work through these distortions? When do you get a real clear picture of what's happening in this labor market?
That's a good question, John. I think we're going to have to wait until probably the fall. Now, that doesn't mean that the Fed's not going to see some further progress toward that substantial progress that they're looking for. Certainly, if by the time of their July FOMC meeting, which comes at the end of the month, they've whittled away half of those jobs or brought back half of those jobs lost because we're getting in the million-plus jobs range per month. Certainly, that's much further along in terms of the progress they want to see. But I want to see the extended unemployment benefits expire at the end of September. I want to see that workers' wariness of going back to work more fully because of health concerns. I want to see that continue to wane. And so those special factors have to be out of the picture, and then we can really get an underlying sense of what the cross currents are that may still be lingering. Well, whatever might keep us back, hold us back from gaining back full employment.
I wanted to talk about that moment, that period before we get to September as well, Ellen, because I think that's really interesting. The execution risk around the demand picture at the moment. The estimate's massive. The demand's clearly huge in this country right now. Do you think there could be a problem meeting it with labor supply, given what we're hearing out of Montana, out of South Carolina at the moment, what we're hearing of the PMIs, the ISMs, a labor shortage? Do you think there's a risk here that could show up in the data too?
Yeah, so John, I do think it's showing up in some of the surveys, right? The business surveys where price diffusion indices, labor cost indices are going through the roof. And part of that is that mismatch when you have the economy that's opening up more slowly than demand that's coming back. And so that mismatch can create those price pressures. The real question is going to be, are those temporary? So as we do bring more labor back, do those cost pressures come off, or do they linger longer? You know, I believe that some of those labor costs are more sticky. The Fed right now is assigning an assumption that that's 100% transient, and it'll take some time for them to realize that a lot of that might be sustained. And I do think that doesn't necessarily mean margin pressure for companies. I do think that this is one of the first times we've seen in a long time that there will be pricing power for them to pass that on into final goods prices. Households have a lot of cash. They're very price tolerant right now.
Ellen, what's the Fed getting wrong, in your opinion, with respect to saying that this is transient rather than sticky, as you see some of these wage increases?
So, Lisa, it's not really the reaction function that I think they're getting wrong. I think they're doing the right thing, because you don't want to start tightening up monetary policy and then find out later that when you tried to battle low inflation for so long that you jumped to the gun. These very well could be transient pressures. I think what we're looking for that may differ from the Fed is that this is a very rapid recovery with a lot of fiscal and monetary policy stimulus behind it. And that can create these inflationary pressures that look more cyclical. And we do think that we're much later in a cycle in terms of the way that the economy is behaving than, say, an economy that just entered expansion. And so you do get cyclically sensitive inflation more quickly, and those are the more sustained parts.
Ellen, I'm going to give you a major shout on that. You absolutely nailed the heating up of the economy and then the mystery of where we are in Q3 and in Q4. George Saravelis over at Deutsche Bank moments ago pointed out, as our international FX strategist, how alone Washington is given a lack of tapering and, frankly, a ginormous fiscal policy. As we go into this jobs report, how alone is Chairman Powell? How alone is Congress internationally?
So I do think that it is a little odd to see other central banks, say, moving toward the tapering or moving into tapering before the Fed. Generally, everyone waits for the Fed to move first. And now some of this is that the Fed's own framework is designed to be extremely lagged in the business cycle. That said, I do think that we're going to be talking tapering soon. I know that Chair Powell is still straight-arming that discussion, but you've got other FOMC participants that have started to say, hey, we should be talking about tapering soon. And tapering is not about tightening up monetary policy. It's about taking your foot off the accelerator. And so I do think that this jobs report is just the start of a string that's going to be strong, and that as we march toward that summer meeting of the FOMC, that they will be opening the door to making these baby steps toward having those balance sheet tapering discussions. They need to start tapering well before they're going to start raising interest rates. And so I do think that discussion is coming.
Ellen, always great to catch up. Good to be with you on Payrolls Friday. Ellen Zentner there, Morgan Stanley chief US economist. Tom, can we just pick up on your final point there? Because I do think it's important. I caught up with Stuart Kaiser of UBS recently about that. He said that portfolio managers can't just sit there and say, oh, 6 months from now, it's going to be transitory. They have to trade the data as it comes in. They need, and he says they need and want, an inflation hedge right now. And he says understanding how a portfolio manager looks at it and how a policymaker looks at it is really key to understanding how the market is going to react. They're two different conversations.
Right. Well, then taking that over to the physics of the pendulum, as Ms. Zentner just pointed out, is a distinction between tightening, which is the gloom fear, versus a deceleration of the benefits that they've done. Why can't they decelerate and get back to normality? There's a camp that says they're not going to do it, and there's a camp that says, you know, it could work.
We had this conversation 8 years ago. Tapering isn't tightening.
Timeless.
The balance sheet's still expanding, Lee. So that's going to be the conversation again later this summer.
But I think Priya Misra put it well, that if the Fed doesn't signify that they are thinking about it at this point, they risk a much bigger disruption down the line as everybody tries to exit all at once. And I think that is the calculus the Fed has to look at, John.
Let's take a couple of months off. I'll see you later in the summer. Seems to be when the Federal Reserve conversation might change a little bit more. Coming up,
what a shock, Lisa.
After the jobs number at 8:30 Eastern Time, we will have Neil Kashkari at the Minneapolis Fed. Can we just confirm you have had more vacation than me so far this year? Just want to confirm that. Equity market's doing okay, up 10 on the S&P, up 1/4%. Lisa away all next week.
Oh my word!
What is that about?
Oh my gosh, can you believe I actually get time off?
You're taking a week off?
I am.
Basically a retirement. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden stunned European allies and the drug-making industry with his support for waiving patent protection for coronavirus vaccines. That was a reversal of long-standing U.S. policy that its companies' intellectual property is sacrosanct. But there are signs the president is interested in a more modest compromise. Meanwhile, Germany has said it opposes a waiver. A warning from the Fed. It says a rising appetite for risk is stretching valuations and creating vulnerabilities in the U.S. financial system. The central bank says prices could be vulnerable to significant declines if that appetite falls. Fed Governor Lael Brainard also cited the implosion of Archegos Capital and called for more hedge fund disclosures. And British Prime Minister Boris Johnson has dealt a major blow to his chief political rival. Johnson's ruling Conservative Party won a crushing victory in the parliamentary district of Hartlepool. It had voted Labour every time since the seat's creation in 1974. The loss is likely to intensify pressure on Labour leader Keir Starmer. And the price of copper soared to an all-time high. The metal went over $10,200 on the London Metal Exchange. Copper is considered an economic bellwether. It's in the forefront of the rally that's driven raw materials to multi-year highs or even records. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We would have to have some, severe disappointment in terms of the outcome. So an obvious case in point, unfortunately, sadly, would be the return of COVID in a big way, which caused further economic dislocation. Now, we're not forecasting that at the moment. We don't see the evidence of that, but it would have to be something that, caused a negative shock.
That was Governor Bailey, the Bank of England governor, speaking to our colleague and good friend Francine Lacqua on what it would take for QE to extend beyond this year into 2022 over at the Bank of England. From New York City this morning, good morning on this Payrolls Friday alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up 10 on the S&P. We advance 1/4%. Yields unchanged. 156.47, just a nudge lower in the last hour or so. Going into the payrolls report in about 42 minutes. In the FX market, euro dollar 120.72, crude 64.56 and down around about 1/4% there. The numbers, you are familiar with them by now. The range is 2.1 million. All the way down to 700K, and the median estimate on payrolls, Tom, is a nice round number. It's 1 million.
1 million, about 5 times what a good month was long ago and far away. Really looking forward to where we are here in 40 minutes. Yesterday, we announced the death of David Swensen of Yale University. He changed how all of us think about what do you do with a portfolio, what do you do in the balance between sectors, this odd thing called factor investing, all devolving down to growth and value. David Wilson drives forward the conversation this morning in honor of Mr. Swensen, and this is the heart of the matter. There's value and there's growth.
Absolutely. Either you buy the stocks that are relatively cheap when you compare them with earnings and sales and other valuation gauges, or you buy the ones, companies with the fastest growth. And we've seen a real reversal in the past 8 months or so in terms of investors' preference. It's gone more toward value, away from growth after years in which the fastest growing companies were all the rage. And what's interesting, Keith Lerner over at Truist Wealth, he's their chief market strategist, and he's on board with the idea of focusing on value rather than growth. But he's pointing out, though, that it really comes down to 2 industry groups that are kind of dictating this balance. Finance when it comes to value stocks, and technology when it comes to growth stocks.
That's a concentration of the market. So are you saying the value of today is different than the value of 20 years ago, and the growth of today is different than the growth of 20 years ago?
Well, I mean, you'd really have to go back to kind of make those comparisons. It's clear, though, that these 2 areas have become increasingly dominant. When you look at technology within, say, the Russell 1000 Growth Index, which Lerner uses in making his comparison, it's more than 40% of the value of that gauge. Now, finance, also the biggest component of the Russell 1000 Value Index, a little bit more modest at 20%. But if you switch, say, to the S&P 500 Pure Value Index, which is a gauge that really focuses in on the companies in the S&P 500 with the strongest value characteristics, well, you're talking about a number that's above 40%. So it's clear those 2 areas have increasingly become the focus.
David Wilson, one more. You're on the equity side of things, your leadership in founding equities at Bloomberg News. You've never seen a jobs report like this.
No.
Absolutely extraordinary. Your thoughts, please.
Absolutely not. I mean, it really comes down to whether it moves the needle in terms of Federal
Does
Reserve
it move the
policy.
market?
Yeah,
Well,
absolutely.
I'm asking.
I mean, that's the question.
I got to find an entry point, David.
Well, you keep looking, Tom.
I'm looking.
And, about 40 minutes from now or so, we'll have a better idea if now is the time.
Dave, we've got to leave it there as you two carry on your argument. Dave Wilson there, our stocks editor, alongside Tom Keene. Tom, if we can pick up and talk about the financial stability report out of the Federal Reserve yesterday. This comment from Governor Brainerd, the head of the financial stability mechanism, going on to say the Archegos event illustrates the limited visibility into hedge fund exposures and serves as a reminder that available measures of hedge fund leverage may not be capturing important risks.
You think?
Couple of issues around that statement, though. Referring to Archegos as a hedge fund is one point there. Second point is this idea that risk appetite could be in charge of vulnerable price action and all of the above, when it's the Federal Reserve that's really shaping risk appetite at the moment too. Lisa, some tremendous pushback, as there always is when this report comes out, and a ton of snark too. But I do think some legitimate concerns about exactly what the Fed was trying to say and who they were trying to talk to yesterday when this came out.
And this concern that policymakers are conflating hedge funds and family offices at a time when the regulations are very different. Look, this report came under a lot of criticism, not just for that, but also for stating the obvious, that basically if you have risk appetite increase and you have really high valuations, that could eventually become a problem. What goes up maybe may have to come down at some point. But there were some really salient points in here, John, in particular about how very high levels of debt paired with high asset price valuations could be a toxic mix if there is some sort of deflation or some sort of withdrawal of stimulus. And this, to me, is a real concern. In other words, what are the consequences of companies taking the cue from the Federal Reserve, borrowing more money, and basically looking better for now as long as the stimulus is ongoing?
Do you want a stat from M&G Investments? They have this great Twitter handle, out on Twitter, of course, Bond Vigilantes. They say the following, Tom. April saw 0 high-yield defaults for the first time for 2 years. At the same time, it was the 5th biggest month for high-yield issuance in history. Of course, the majority of that going to refinancing. Bank of America's take, rating upgrades are setting all-time records. There's more to come.
Yeah, at least it's been way out front in this on the move of some of those spread markets under what it was. I don't know, was it 3% or something like that? I just think, John, it really underscores how absolutely odd the times are in the titanic debate we're having on Bloomberg surveillance between the bulls and the bears. It's the oddest of times.
Well, let's pick up on that piece yesterday. The one key input, if you were to pick one for risk appetite going through the summer, I think this echoes the words of Leon Cooperman of Amiga earlier this week. Forgive me, Lee, if I get this wrong, but you can speak for yourself, and I think you spoke loud and clear earlier this week. It's the Federal Reserve and the balance sheet. So if risk appetite is shaped by what the Fed does with its balance sheet in the months to come, Lisa, it's kind of bizarre that they were talking about risk appetite being elevated and it leads to this vulnerability in broader markets if it's risk appetite being shaped by the Federal Reserve.
Yeah, basically, it's using the passive voice when they're the active player here and basically ignoring that factor. There is a question, though, when you talk about the corporate default rate, and I'm really glad you brought that up. There is a question, have these defaults been taken off the table or have they just been postponed? In other words, will we allow some of these zombified companies to default at some point, or have we created a new cycle where they will continually be supported by Fed policy? And this is one major conundrum to Fed policy going forward.
Kit Jukes of SocGen captured the whole story quite nicely. I mentioned the quote earlier this morning. I'll repeat it again.
Quote.
The barman suggested another drink and warned of exuberance. The Fed is, to all intents and purposes, warning about irrational exuberance in the equity market while keeping rates at historic lows in the middle of a once-in-a-lifetime economic boom. Tom, the take of Kit Jukes over at SocGen.
I'm looking at the real yield. I mean, you're getting ready for your show, The Real Zombie, here this afternoon. I'm looking at the 10-year yield. Yeah, it's a rebrand, negative 0.89%. There's no textbook I have, John, that mentions a real yield of negative 0.89%.
I feel like a zombie by the time we get to this afternoon on a Friday on Payrolls Friday. Coming up next, Savita Subramanian, Bank of America Securities Head of Equity Strategy. Looking forward to catching up with Savita. A 3,800 price target over at Bank of America gets your attention.
Yeah,
the S&P 500 through 4,200.
I think I should wait to buy my first share.
Maybe you should keep waiting, Tom. Yields 156.29 on 10s, euro dollar 120.67. Your payrolls report is 34 minutes away. This is Bloomberg.
of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vows in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Is important, but it's really the data not right now. It's going to be the data in August, September, when we can say that the reopening is behind us.
Most forecasts suggest that at the end of this year, we will be better than we were projected to be before the pandemic.
We should all recognize that the economy right now is experiencing a demand shock, the likes of which we haven't seen since World War II.
A lot of people left the labor force, and the question is, will they start to come back in?
The last thing in the world I really care about is that wages are going to explode. They are not.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on this Jobs Day on radio and television across America. Extraordinary history will be made. The estimate, 1 million jobs. John Farrow, I'm going to cut to the great debate which spans everything we talk about. Professor Blanchflower of Dartmouth nails it. What will wages do? He says wages will not explode.
There's a compositional issue here, Tom. The low-wage group, those earners come back into the market in a bigger way. That's going to distort the overall number. You have to reverse engineer what happened 12 months ago. So noise and signal, separating the two, it's going to be pretty difficult at 8:30 Eastern. The thing for me, and I think Lisa too, overwhelmingly the focus on how the market responds to this, both an upside surprise or a downside surprise. Is there some asymmetric risk around the bond market and where we are at the moment, south of 160, going into payrolls?
Our hallmark, John, is to look across equities, bonds, currencies, and commodities. Suddenly, commodities front and center, they're sending a signal.
Copper, all-time highs. Demand demand and a demand shock, and I think that's the phrase to use here. It is a demand shock that is working its way through the commodity market. It's working its way through the labour market as well. We've heard again and again and again repeatedly in the ISM, the PMI, all the survey data, there is a struggle to find workers, and maybe that's the risk around the headline number 2. These are huge numbers. You don't just bring up an Excel sheet and type in 1 million and hire 1 million people in America.
Right.
That's a real process of actually hiring real people, and that's really difficult.
Lisa Brown, it's a demand shock here as we're now 28 minutes away from this important report. Michael McKee with Neil Kashkari afterwards. To me, the demand shock here, Lisa, is the social shock of 2 Americas. 1 million jobs, and they're only going to one America.
And this is the reason why the Fed is looking at the dispersion of those job gains, at the composition of them, and everyone's looking to the Fed in order to take cues as to how to respond to the market. I want to go back to something that you guys were talking about, the Danny Blanchflower versus Ellen Zentner distinction. The question of, will these wage increases be sticky that we see in response to tight labor markets as we deal with these frictions of bringing an economy back online? Danny Blanchflower says no, they are not. Ellen Zentner says yes, they are. And again, it goes back to the question that we were talking about with respect to savings. Will people go out? How much will they spend?
John, you're going to have the distinction of speaking with the Secretary of Labor. He's a different Secretary of Labor than we've ever seen before. A really feet on the ground mayor of Boston, Martin Walsh. John Farrell, what's the distinction you see in this report that you're going to drive forward to the conversation with the Secretary?
Well, of course, it's dependent on the numbers, Tom, but I think the tension between the Republican governors right now and some of the policies that have come out of this administration, the additional $300 in unemployment benefits, weekly benefits, the additional amount of money that's been offered to the unemployed in states across America, and pushback from Montana, pushback from South Carolina, they believe it disincentivizes work. Those additional benefits don't end until September. The South Carolina administration, or rather the governor of South Carolina, Tom, would like that to end in June. Montana's moving much more quickly. I just wonder how much this piles up across America in the months to come and what that tension looks like with the administration. I still haven't heard the administration's position on this. I'd like to hear that in a couple of hours' time.
Let's get the data in quickly here. Real yield doesn't give me much, negative 0.88 on the 10-year real yield. Yield just churning all in all in the nominal space. Futures up 8, Dow futures up 96, and the VIX 18.33. Savita Subramanian is with us, Bank of America, head of U.S. equity and quantitative strategy. John, why don't you bring in Ms. Subramanian here? It's a shocking call. I am waiting for Savita Subramanian's entry point to buy the first share.
3,800 is the price target on the S&P 500 over at Bank of America. Savita, to give you some credit, 6 months ago, this was a very, very bullish call. We have moved really, really quickly in this equity market since early November. I imagine you've had some pushback recently. Can you just shine a light on the conversations you have with clients at the moment? What do they sound like?
Oh, just emphatically bullish. I think that equity sentiment is increasingly euphoric. Conversations we have with investors of all types, so hedge funds, long onlys, and individuals, the net message is you want to buy this market. This is what we're hearing from all types of clients. And this is how bull markets typically end. I mean, I don't know if we see a full-fledged bear market, but I think we are really well set up for, a 5 to 10% pullback, which happens super frequently. So 5% pullbacks happen, 3 times a year on average historically. 10% pullbacks happen once a year. We haven't had one since last Q2. So I just think this is a market that you don't necessarily want to enter here. I mean, look, at valuations are super stretched. We're at points in every valuation we look at, except for price to free cash flow, the market looks incredibly expensive. The sentiment is super bullish. I mean, this is a situation where all of our models are giving a net bearish message, whereas 10 years ago, all of our models were giving us a net bullish message.
Savita, you're the queen of the Excel spreadsheets. I want to go to the denominator of a lot of these different ratios right now. The bull case is earnings will deliver, that we'll see some form of high single-digit, double-digit growth, and that'll drive through to free cash flow. You know the drill. You say, maybe not. Is it a question of earnings, lack of confidence?
Well, it's not. I think earnings are going to be strong, but I think that you're going to start to see, we're looking for, 30% earnings growth this year. But if you look at multiple expansion last year, it was essentially, kind of anticipating that. So I think that the market gains are likely more in on earnings, and the market anticipates. But I think the other thing to watch is free cash flow, right? The S&P looks cheap on free cash flow right now. The reason is companies have been underinvesting, underspending. Now all of a sudden you've got CapEx guidance through the roof. Everyone's saying they're going to spend on CapEx, be it onshoring or just refurbishing plant. We've got this infrastructure bill, which is encouraging CapEx in certain pockets. So I think that free cash flow generation is also compromised by the idea that companies are going to be spending more money. So I think that's another thing to watch. And then, of course, inflation. I think that's what we're really keeping an eye on, because if you look at the key theme this earnings season, inflation mentions increased by 800% year over year in terms of companies talking about margin risk, kind of higher costs from either labor or raw materials.
Yeah.
So I think that's the other risk that we haven't necessarily seen play through to margins and earnings. So, I think earnings are going to be fine this year. I think the market's anticipated a lot of that recovery. But I do think that inflation risk is what we want to watch here. I don't know if it's going to be as transitory.
Savita, can markets have a correction if the Fed keeps its policy where it is for the foreseeable future?
Sure. I think there are a lot of things that can cause a market correction. I mean, look at some of the events we've had just over the last few months. We've had, de-risking, forced selling of institutional investors that have caused little air pockets in the market, or forced selling across other parts of the market. So I think liquidity risks to the S&P are actually higher than average. I mean, the other thing I worry about is that if you look at where pension funds and big money have moved, they've actually moved into a lot of illiquid parts of the market, like private equity, SPACs, like this sort of low interest rate beneficiaries. And if anything happens to rattle some of those parts of the market, I think that what big investors are going to be forced to sell is the S&P 500, the most liquid asset class. And that could put undue pressure on equities for totally non-fundamental reasons, for technical reasons. So, just the crowding of the S&P 500, the bullish sentiment, the fact that everyone's betting on low rates and high earnings, I think all of that just spells, an environment that's very conducive for a pullback.
Savita, always enjoy catching up with you. Thanks for being with us this morning. Savita Subramanian there of Bank of America with a 3,800 price target. Tom, by definition, a year-end price target cannot be wrong because it is not year-end. It is May, and we are 10% away from that, and it's not unthinkable to have a 10% correction through the summer when you're talking about a Federal Reserve potentially tapering. Some people, for a lot of people, in fact, that message might resonate with them.
And she nuanced that it's not just a 10% correction, but these pullbacks of 5 or 7. We're in a media frenzy in this great bull market where if we pull back 3%, we're crushed. We make jokes about it. Stocks cratered today.
1.5.
Come on.
Down 0.6 of 1%.
Fancy people look at the standard deviation. Forget about that. Just use what Savita's got, which is, you frame out negative 10%, negative 18%, and really ugly is negative 35%.
This market's moved so quickly, Lisa. So fast.
Savita said something that I'm still thinking about, and I think is a very important point. The idea that the S&P 500 is used as a liquidity sleeve for investors who are increasingly going into untradeable assets. This idea that if there is a disruption in other markets, you could see an undue sell-off. And I think that we have seen that before. And to what degree do we see that again? To what degree has leverage built up in a different kind of way in harder to see corners that will be represented in large cap equities?
Harder to see corners, seeing round corners.
Yeah, just trying to see around them.
We like
They're
all
hard
that.
to see.
In fact, what you mentioned is interesting because we actually saw the reverse of that with Archegos, didn't we? There's some really big longs on single names and potentially a short on the index. Thought that was interesting. Wasn't the S&P 500 actually up that day?
Yes, and I will say that, yes, it could have the opposite effect, but the whole point is that these other markets and these other influences that are not related to fundamentals can have undue influence because of where we are. I think that's important, and yes, it's a corner worth looking at.
We are vulnerable, according to the Federal Reserve, vulnerable to a shift in risk appetite. Still getting my head around that, Tom. Isn't that the most ridiculous line?
I'm just listening, yeah.
Tom, if someone came to you and they'd written that article, that we're vulnerable to risk appetite shifting.
Third person.
What would you parlor game?
What would you say back to them?
I
if
would
you were
say
editing
it's a
that
parlor
piece?
game.
If you were editing that piece,
I would say,
what would you say?
Who are you talking about?
It's just the back and forth of trying to get
someone
to June
submitting that piece
16th.
here at Bloomberg that risk appetite, markets are vulnerable to a shift in risk appetite.
What could cause that?
Yeah.
The editor would be sending it back, saying, "What are you doing?" The Federal
Well,
Reserve
that's the language.
published
I
it.
mean, listen to me. What's Secretary Yellen going to say today at this press conference?
Absolutely nothing.
She's going to go. She's the Secretary of Treasury. I guess she says something about
Well, I
the
think,
budget.
Tom, for the mainstream media, for cable news, for the political channels, they want to explain away what's about to happen with wages in 18 minutes' time.
Yeah, I think that's fair. Yeah.
Coming up, Jim Glassman at JP Morgan, your payrolls report, 18 minutes away. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden stunned European allies and the drug-making industry with his support for waiving patent protection for coronavirus vaccines. That was a reversal of long-standing U.S. policy that its company's intellectual property is sacrosanct. But there are signs the president is interested in a more modest compromise. Meanwhile, Germany has said it opposes a waiver. And Pfizer and its partner BioNTech have become the first coronavirus makers to ask U.S. regulators for full approval. That's an important step towards making the shot a sustainable revenue source. Right now, the 3 shots approved in the U.S. are allowed only for emergency use. That designation can be pulled away at any time. A petition demanding that the Tokyo Olympics be cancelled gained support in Japan. The government today extended the state of emergency in the city and beyond to control the spread of the coronavirus. Prime Minister Yoshihide Suga has been determined to press ahead with the Tokyo Games. Polls show most Japanese voters want them cancelled or delayed. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Follow the earnings. I think we underwrite businesses, hard to underwrite price volatility day to day. But I think the demand shock's going to play out for far longer than people expect as corporations, consumers, and governments continue to behave in the way they behaved over the recent past.
This is a demand shock. Charles Cantor of Neuberger Berman there. Your payrolls report 12 minutes away, and that demand shock will be seen loud and clear. That's the expectation. Big moves in the commodity market year to date. Crude putting together some back-to-back weekly gains again. 64.27 on WTI. Call it 64.28 and down about 0.7%, Tom, going into the jobs report.
Absolutely. 12 minutes away, and in this historic moment for this show, all we've done on economics here at Bloomberg, on the economy and Bloomberg Surveillance, we start strong before this historic moment with James Glassman. He is the J.P. Morgan Chase Commercial Banking, and we are thrilled he could join us. He has so many times. Particularly with his affinity to his Northwestern in Robert Gordon. Jim Glassman, you and Professor Gordon, the giant of labor economics, have never, ever, ever seen a jobs report like this. What will you search for at 8:30?
Well, I'll tell you, we've never seen a report like this because we've never really seen the collapse that we had last year. So I'm looking, I think it's important to remember things are moving very quickly, and businesses opening up again, so we just don't really know. There's a lot of ground to recover here. Even with the 1 million, basically, employment is still 10.5 million below where it would have been had there been no pandemic. And so we're getting a good start here. I think we're expecting to see hospitality and leisure, the educational system. I see school buses driving everywhere. That tells me there's lots of jobs coming back. And so I think until we get the bulk of the 10.5 million jobs back, it's going to be hard to sort of figure out. We're not really there yet, and that's what the Fed's point is.
Jim Glassman, you led decades ago on the analysis of teenage employment and teenage unemployment. We all observe that teenage jobs have basically disappeared. What is your observation right now on every window in America having a help wanted sign in it?
Yeah, this is a huge demographic thing going on because as people are moving to retirement, there's an outsized group of people moving to retirement. There's just a lot of jobs opening up. The people who are really unemployed that worked in the restaurants, the bars, the fitness centers, they don't have the skills for those. So it's really weird to hear that we still have 10.5 million jobs to go before we get people back to fully on the market. And yet our businesses tell us we got 7.5 million jobs we can't find people for. And that's a sign. Japan knows this story, so does many people in Europe. It's a demographic issue. What it tells you is if you're young, looking for a job, coming into the market, there's going to be a lot of opportunity. You'd like to come into a market where the demographics is opening up possibilities. But the problem is you need to get the skills and the training, and that's the big challenge for America.
Jim, one thing that you do so well is you get in your VW bug and you drive around the country and you get the sense of what it looks like on the ground. Based on what you see on the ground, how much do you buy into this idea that people are not going back to work because of benefits that they are still receiving from the government versus just the friction of the demand shock coming back in the opposite direction of where we were a year ago?
Yeah, that might have been a good story last summer when unemployment benefits were really quite generous, but those things exhausted at the end of July. And honestly, I think people are not coming back because they're getting compensated well for being unemployed. They're not coming back because we've had these restrictions on hospitality and leisure, and it's only now that things are opening up. So those jobs, as they open up, you're going to find a lot of these people stepping back in again. So you know, early in the early days of the pandemic, it made sense to be generous with people, and it did create disincentives. But I don't think that's really the reason why we have so much unemployment right now.
All right, so let's push that forward, Jim, into wage increases, because people are saying that's perhaps one reason that people are staying out of the labor force. They're waiting for higher wages. Other people saying that's not the case. There just aren't the workers to fill the jobs. How sticky do you see the wage increases? Do you think that they are stickier than what the Fed is saying?
I don't really know. I mean, I think one thing we are noticing is wages do respond to unemployment, to the labor market conditions, more than you see in prices. So I think, you know, all the different things that are going on is very confusing because the pandemic's created all kinds of dislocations, which is hurting low-wage workers. And the demographic thing, opening up jobs that, you know, people don't have, a lot of my clients are complaining they can't find the people. So they're having to offer more pay. Well, that's good news to me because that'll solve the problem. But, of course, you've got to have the skills and the right skill set to get those jobs.
Jim Glassman here, 8 minutes away from this report. Bridgewater of Connecticut just puts out a very nuanced note about inflation worries, and they do say the key here is to understand this economy from bottom to top. Boy, does that sound like the Jim Glassman prescription we've known for years. What does Jerome Powell need to know about the bottom of the economy right now?
I think he's got his hands around this. There are a lot of dislocations, bottlenecks that happened in the pandemic. So the Fed expects that there are a lot of price pressures that you're seeing in the commodity area. But the Fed is saying, let's chill. A lot of this will sort out as we move down the road. And if you look at futures prices, you'll see, like you look at lumber and a bunch of commodities, the market agrees with that idea that things are going to slow down here. So I think the Fed is right to be patient, because you don't want them having to fundamentally shift policy just because of some short-term problem that is related to the pandemic. So bottom up, I think there are a lot. The conversation in my world has changed dramatically to everyone's talking about price pressures. But we know why that's happening. There's a lot of bottlenecks. There's all kinds of things going on because of the pandemic. I think that'll settle down. And, you know, personally, I think when the economy we're still not back fully to where we want to be, you don't worry about inflation problems when you see a thing like that. And I think the Fed is right to be patient on the inflation picture. They want to take a long-term view here because they want to make sure that inflation expectations don't keep going below 2%. That puts a real cap on what they can do when there's in the event of a new crisis.
Hey, Jim,
you can
we got to go.
Rates to zero.
Jim, it's great to catch up as always. Jim Glassman there, JP Morgan Chase, commercial banking head economist. Going into the payrolls report, 5 minutes away. Your estimate, Tom, 1 million, a nice round number for you. Unemployment set to come down from 6 to 5.8. That's the estimate in our survey. Wage growth year over year could be negative. Just remember what happened a year ago. A lot of the individuals at the lower end of the workforce, the low-wage earners, had to drop out. That sent the wage number up. You've got to reverse engineer that going into this morning's print.
As Ellen Zentner said earlier, the size of the labor force will be key. It'll be interesting to look at some of the underlying denominator data of all of these two surveys.
Lisa, what are you looking for?
I'm looking for the composition. I'm looking for how jobs are coming back. I'm looking for whether the decline that we've seen in the leisure jobs, just dramatically, the deficit that still exists, whether that's actually getting made up or whether we have a long way to go, John.
And what I'm looking for in the bond market is how the bond market responds to whatever the number might be. Your 10-year yield right now, 156 on 10s, on 2s. We're in and around 16 basis points. In the equity market, up 10 points on the S&P 500. We advanced 0.2%. We're looking for 1 million. That is your median estimate, and the range is wide, wide, wide. 2.1 million all the way down to 700K. The payrolls report on TV and radio next on Bloomberg Surveillance.
Our focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City for our audience worldwide, here comes the jobs report in the United States of America, with equity futures positive, up 1/3% with your payrolls report. Here's Michael McKee.
We're just waiting for the numbers to drop, and they are coming out slowly here. Oh, we have a real surprise here. It looks like a downside number, 266,000. So this is going to get Wall Street's attention, I'll tell you that. The unemployment rate
does... a 6 basis point move in the 10-year yield.
The unemployment rate
yield.
doesn't change. It's 6.1%. So here's a slap in the face to those who thought that we were going to have a massive rebound immediately. Let's take a quick look at the unemployment rates for different groups, because that's what the Fed's watching. Unemployment for blacks went up by 0.1% to 9.7%, and for Hispanics, 7.9%, little changed. But it does seem that some of the stories about having trouble finding work were exaggerated, or else a lot of people got jobs in the prior month in March. Let me just check the revisions here,
I want you
Tom.
to check the revisions right now. 30 seconds. John
Not much.
Farrell, we're seeing jump condition moves here in the market. John, start with the 10-year yield.
A big downside surprise, delivering a big bid into the bond market and a break of 150 on 10s at 149, down 8 basis points. Your 2-year yield even comes in a basis point too. In the equity market, we almost don't know what to do with this. The S&P 500 futures stay positive, up about 12 points, but there's the move in the bond market. A big bid. I think we need to be really careful with this number.
Yes.
Really, really careful. And let me go through some of the reasons why. It is clear we're going through a demand shock in this country. It's in every single data point you look at in the United States of America. The number one complaint that you see in the PMIs and the ISMs is the ability to hire, labor shortages. And Tom, I don't know if you should see this report this morning as a reflection of suboptimal demand in the economy right now, but rather maybe some of the technical issues that are going on within the labor market and the ability to rehire. We've heard it from the governor of Montana, heard it from the governor of South Carolina, and you see it in the PMIs and the ISMs as well. So I think you've got to be very, very careful with this downside surprise this morning.
Matt Bessler over at T-Live nails it as well. This is very odd. Michael McKee, this goes to these appendices that are put out as well. What will you search for in the sub-articles by the Bureau of Labor Statistics and such that explain this stunning change?
Well, let's take a quick look at some of this. The interesting thing that is also putting a weight on the markets is that March, 916,000 was revised down by 146,000. The February payrolls were revised up by 68,000, but on net, you have 78,000 fewer jobs in the prior 2 months than we thought, and we get this very low report here. Yeah. The participation rate, 61.7, does rise by 0.2%, which suggests to me, and I'm just looking right now, the labor force rose by 430,000, so that's a healthy number, and that may suggest a reason why the unemployment rate did not move move, because we saw 328,000 in the household survey for newly employed, whereas only 102,000 people were reporting they were newly unemployed. So that the unemployment rate is not really a surprise, but the job creation rate is the shock there. I want to just quickly check.
Wait, Mike, before I'll let you check, but I want to just bring some other aspects here. Another big surprise is the average hourly earnings increased much more than people thought. Some people were expecting them to decline, and I'm wondering how much this signifies that some of the lower wage workers were not brought back in. Either it's because travel hasn't restarted fully, there still are closures, or whether it's just these frictions that we're seeing ongoing in leisure, in hospitality, et cetera.
Yeah, we don't really know what's going on here, but we do know that because the lower paid workers are not coming back, that's added, not coming back at the rate we thought, that's added to their average hourly earnings this month. They were up 4.2% in March, so a 0.3% rise is much smaller, but it was expected to be a 0.4 drop. Now, one of the couple problems you could have here is people may want to go back to work and their jobs aren't there, or they may be waiting on these unemployment checks, as a lot of employers are saying, or schools hadn't opened yet through much of April, and in many places are still probably closed, and so people are still dealing with childcare problems and can't go back to work. So what we're seeing here, it seems, is a backup, not a labor shortage as such, but a backup in the ability of matching people to jobs. I just looked at the service industry jobs, and they were up 234,000. So almost all of the jobs come in the service industry. Manufacturing, it looks like, fell by 18,000 jobs, which is a little odd because, as John mentioned, we had those big ISM numbers. We're seeing a lot of manufacturing stories about how companies are running full out.
Yeah.
So that's kind of interesting that manufacturing jobs fell by 18,000 and motor vehicles and parts were down by 27,000. Now, that also may be contributing to this because, remember, can't get chips, and the automakers are shutting down assembly lines. So, there's 27,000 jobs that probably would have been there, but aren't this month.
Mike, the bond market bouncing back just a little bit, down 6 basis points. We're back through 150 again. Clear downside surprise on the headline number. Yields coming in across the board, particularly at the long end. At the front end, we're in about a basis point. Your equity market still elevated by 0.2%. I want to go back to something we've been discussing all morning. The risk around the number was not about whether there was inadequate demand in the economy right now. There's huge demand in the American economy. It was about the ability to rehire. And why maybe, to your point, Mike, some people were hanging back and not going back into their jobs. But there is one consistent story this morning. And maybe it's too early to talk about it, too premature, because I do think you have to be careful. But there is one consistent story in the data, in the PMIs, great demand. In the ISM, great demand. The one thing that came up again and again and again was the difficulty hiring. And we've heard from Republican governors through the week, from Montana, from South Carolina, that they believe that the additional entitlement spending, the additional unemployment benefits is holding back the recovery. Now, Mike, I'm going to catch up with Secretary Walsh in about an hour from now. You're going to speak to the Minneapolis Fed president, and I think they are the questions at the epicenter of this debate right now. Is this jobs report just a one-off, a fluke, or is it evidence that some of the entitlement spending in the last few months is holding back this recovery?
Yeah, well, that's the real question that has been debated for some weeks now by employers. We don't have evidence on that. We have anecdotal reports, but we also have some of the other reasons that I mentioned. It's probably a combination of all of that. I'm sorry, Lisa?
Mike, this has been a tremendous report, and luckily we get some information from Minneapolis Fed President. I believe you have him online.
Good morning, Neil.
Good morning. How are you?
Good. Neil Kashkari is the president of the Minneapolis Fed, and he's joining us now on Jobs Day, and we thank you very much for doing it. We're just been tied up here talking about this big surprise of a number. I know you haven't had a chance to digest all of this, but does it tell you anything?
Well, I mean, I think it confirms that I feel very good about our policy approach, which is outcome-based monetary policy, which is let's actually allow the labor market to recover, let's not just forecast that it's going to recover. Let's actually allow the labor market to recover, get back to what we call maximum employment, and get back to 2% inflation, and then we'd be in a position to talk about normalizing monetary policy. So as Chair Powell said a week ago, we've had one great jobs report. Let's not declare victory yet. Let's let the labor market heal, and then we can move from there.
Well, let me ask you the question John Farrow was just posing, and that is this because the weak hiring, is this because of the generous unemployment benefits, or is there something else going on?
Well, we hear all the same anecdotes. I was listening as I was checking my emails. I was listening and trying to process the report to your conversation. I think it's all of the things you talked about, Mike. Yes, of course, there are people who are on the sidelines who are getting generous unemployment, and they say, look, we know this is going to expire in 3 or 4 months, and I think and they're individually saying, we think the job market's going to be strong in 3 or 4 months, so why don't I just wait? We know that dynamic is there. We also know there are still massive childcare shortages that are holding back families from fully re-entering the workforce. That's disproportionately affecting women. And there are still a lot of people who are nervous about the virus, who maybe have not yet been vaccinated, or who would need to get back onto mass transit in order to get to their job. And they're nervous about getting onto a crowded bus or getting onto a crowded subway. So I think there are a number of factors, but most of these factors should work themselves out over the next few months if the vaccinations continue, if the variants don't flare back up again. That's why I feel pretty confident that most of the pricing pressures that we're going to see are in fact going to be transitory, and we can get something back to a full economy, in the foreseeable future.
Well, I guess the word to describe the folks on Wall Street this morning with this number is gobsmacked, but you don't seem to be. You're not surprised.
Well, it's not that I forecast this, certainly not at all. But this is a highly uncertain environment that we're in. This is not the financial crisis that we experienced, so it's going to be a different recovery. This is a healthcare crisis, and how the American people respond. It was not simply about lockdowns that led to the economic downturn a year ago. We locked ourselves down as Americans because we were scared. We were nervous. I certainly haven't been out to the movies in a year or year and a half. I'm for the first time taking my family on a plane tomorrow because my wife and I have been vaccinated. And so a lot of this is about individuals feeling safe to go back to normal, to get back on the buses, to get back on the airplanes. And how do we get there so that the vast majority of Americans feel safe again? I do think it's going to take time, and there are going to be ups and downs.
Do you think it's going to take significantly higher wages to attract workers? Are we going to see kind of a wage push here?
I mean, to be honest with you, I hope so. I hope we see employers step up. That was one of the things that was extraordinary about the last recovery. It took 10 years to return to something like maximum employment. And I'm not even sure that we quite got there before the pandemic hit. And it was only in the last few years of the recovery, after many years of businesses complaining that they couldn't find workers, only in the last couple of years did we finally see wages start to pick up, especially for those lowest income workers. Businesses will do anything they can do to try to meet their labor needs, and the last thing they want to do is raise wages. And so if we can get them to say, you know what, I raise my prices for every other input into my business, maybe I ought to pay fair market wages for my labor. I hope that process happens more quickly. We can draw people back in, return to something like maximum employment, and then really drive this economy.
I read a story this morning, an analysis this morning ahead of the payrolls report. It said this jobs number is going to be bad news for Joe Biden because it's going to make the case we don't need more stimulus. Do you think the fact that we get this low hiring level makes a case for more fiscal help?
Well, I think there's a lot in the pipeline from obviously the CARES Act and the Recovery Act that was passed that's very large, that's still working its way, still getting out there. And so personally, I think that combined with monetary policy is probably going to be enough to restore and get through this pandemic and get to something like full employment or maximum employment and get the economy recovered. Now, I know the administration and Congress are debating other fiscal measures for longer-term economic competitiveness, and I think those are important debates to have. But in terms of just bridging the downturn from the pandemic, from the COVID crisis, I think there's a lot of fiscal stimulus still in the pipeline, and monetary policy is still on full throttle to try to get us through this. And then Congress and the administration can debate their longer-term priorities.
Speaking of monetary policy on full throttle, last night the Fed warned that elevated risk appetite is raising risks of what your report euphemistically called a repricing event. Many on Wall Street blame you for that. They say you're no longer taking away the punch bowl, but you've become the bartender. What's your reaction to that?
Well, you know, I haven't done the math on how many Americans are still out of work. As of yesterday, the number in my head was around 8.5 million Americans, roughly, call it 8 million, out of work who were working before the pandemic. And the labor force has grown, or the population has grown since then. So it's probably closer to 9 or 10 million who want to work and should be working who are out of work. So for Wall Street, my friends on Wall Street, and I have a lot of them, I hear from them all the time complaining about the Fed's policies that are, you know, mucking up their trading strategies. I have zero sympathy because there are still 8 to 10 million Americans who want to work, who ought to be working, and we need to rebuild this labor market and put them back to work. And then at that point, there will be plenty of time to normalize monetary policy. And if we're wrong, if these inflation surprises are not transitory but end up being more persistent, we have the tools to deal with that. We have the tools to tighten monetary policy to keep inflation in check. I'm not worried about that. What I am worried about is not having another 10-year recovery for our labor market. That's devastating to millions of Americans, and we need to put them back to work much more quickly.
Yet the question a lot of people ask is, do you still need to do $120 billion a month, or would less get you the same result that you're getting now?
You know, I would say this. Quantitative easing is an inexact science. And what we're doing right now, I think, is supporting certainly the housing market, supporting financial markets and generally keeping the yield curve lower, keeping the 10-year down, which bleeds through into all sorts of other different interest rates across the economy. So we're providing a lot of support to accelerate that recovery. You know, could somebody argue, oh, instead of 120, it should be 110? Sure, we could have that debate. But this is it's an inexact science. So I'm firmly in the camp of what we are doing right now is providing a lot of support. Once we've actually seen substantial further progress, which is the forward guidance that we've given, to get back to our dual mandate.
Okay, traders, it's look like I need to cancel order to buy Bitcoin because it moved too far, as you can see, from our initial order. So the order to buy Bitcoin canceled. Okay, if you wanted to trade Bitcoin, you please wait for another time when I will let you know when I'm going to enter some position on Bitcoin. About another pairs, looks like we have to wait a little bit longer to see what's for development, what chart pattern will give us, what indicators will show us, and what is the best pair will be to trade today. Okay, so please cancel Bitcoin order to buy Bitcoin. Okay, bye.
Obviously been able to do. My gut tells me no. I think I've been in the camp that it may take a few years before we get back to full or maximum employment because we still have a deep hole. Remember, this 8, 9, 10 million number of Americans who ought to be working, who want to work, who are not working, that is still roughly like the Great Financial Crisis, the deepest part of the Great Financial Crisis. So yes, there are sectors of the economy that are doing great. There are sectors of the economy that have fully reopened, but we are basically in a labor market like we were in 2009. And it's going to take time. And I hope it doesn't, like I'm saying, I don't want it to take 10 years. Hopefully we can put this back together in a year or two, but I just don't want to declare victory prematurely.
I guess I got to ask you one more question before we go, and that is everybody was predicting that we were going to get the Fed's inflation target met by the end of the year or sometime early next year. Do you think that could be off, that maybe it's going to be a little bit harder to pull prices up?
Well, I think mathematically it's not going to be that hard to do it because we had such low inflation readings more than a year ago, and those numbers are now rolling out of the math. So I think between energy prices and arithmetic, you're going to see a short-term pop. But just that short-term pop in inflation is not at all going to convince me that that actually means underlying inflation is back to 2% or above 2%. And that's what I'm really going to be focused on. And so we're going to look at, if you look at inflation expectations based on market-based measures, The inflation expectations for the next few years have ticked up, but they're basically where they were for the longer horizon. And so we have a lot of data that we need to look at to try to determine, is this just math, or is this actually underlying inflation that has ticked up? I do think it's going to take more time for underlying inflation to tick up, and I do think it's going to be tied to the labor market. I'll be very surprised if we think that underlying inflation is actually climbing back to 2% or above 2% when we still have millions and millions of Americans out of work who ought to be working and who ultimately will want to work.
Neil Kashkari, the president of the Minneapolis Fed, thanks so much for joining us this morning on this Jobs Day. I'll send it back to you.
Michael McKee, don't run away. I want to talk to you here in a couple of minutes here to get your perspective. I know you've got to read in here. We've got some first looks out here as we look at the data. Catherine Judge up at CIBC in Toronto makes a clear dovish tone intact. Ian Lingen with a smart note from BMO Capital says, watch the pushing out of the Fed liftoff. In the data, you see that red and green on the screen. NASDAQ 100 explodes up 1.4%. SPX up 0.3%. Dow goes the other way fractionally. The VIX comes in 18.23 into the yield space to get to Jeffrey Rosenberg of BlackRock. We had a 146 print on 10-year for a cup of coffee, maybe a transitory cup of coffee, back up to 1.51%, 6 basis points lower in the 10-year yield. Jeff Rosenberg of BlackRock, he will recalibrate, as we all will, off this stunning report. Jeff, how would you presume the Fed will recalibrate?
Well, I think the first thing is that not any one single report is going to determine the Fed's change or its projections, and the expectations are here for a string of reports. Obviously, this report has disappointed that, but the Fed's outlook was not to react to just one report. Now, that's on both the good news and the bad news. And so we'll move on. This report is very much at odds with all the other data. So clearly there's something going on here. When we look across the broader ranges of the reopening economy, it is still consistent with a very strong recovery in labor markets and the economy. And the broader message from the broader range of indicators is what the Fed's going to be looking at for determining their policy. Near term, obviously, yes, markets are going to react. There's positioning near term that will enter into sentiment. But I think the longer run trajectory is still in place.
Jeff, I got to say, Bespoke Investment coming out and saying that this is the biggest miss relative to expectations for non-farm payrolls going back since at least 1998. This is a massive miss, and it really speaks to the mystery underpinning this jobs market. Jeff, when you take a look at these numbers, I understand it's just one data point, but it's what we've got. Is there any conclusion you can draw, perhaps, that the economy is moving a bit slower than people are already pricing in, at least with respect to equities?
So again, we need to be a little bit careful here. This is a very different labor market report in that the scale of the numbers that we're looking at, the gross inflows and outflows, are unprecedented relative to any of those other historical reports. So the comparison is really unfair. And it's something that people are missing, in that underneath the hood, the degree of flows that are coming as a result of, first, the collapse, the closing down of the economy in an unprecedented way, and then the reopening of the economy in an unprecedented way, makes the variability in these reports at a different level. So I think it's a very unfair comparison to say it's a big miss. Now, of course, it's a big miss, but there are large flows going in and out of this labor market in very unprecedented ways. Yeah. The other thing is that in that context, there are very large seasonal adjustment factors that really have a very difficult time in processing this unprecedented degree of reopening. So I'd be careful about that kind of interpretation. I think to the broader question, it remains that the broader range of indicators are still very supportive of the reopening and the recovery.
Jeff, some people will say bonds were right and stocks were wrong. We've been talking all week about this divergence, bond yields remaining steady, while stocks display some belief in inflation, some belief in higher yields. Is that your takeaway, that bonds are right in believing the Fed will hold rates and, frankly, their bond purchases where they are for a much longer time than perhaps stock investors are preparing for?
Well, I think the comparison at the top line level is very difficult to make because underneath the stock market is where all the action. It's like the duck on the water. It's very calm on the surface and everything's underneath. So there's tremendous rotations going on that are very indicative of a lot of changes in investor viewpoints. On the bond side, the bond side priced in a very rapid increase in growth expectations that we saw through the March period. And those repricings basically kind of ran their course. There are a lot of technical factors that people are pointing at, we're pointing at, around the decline in interest rates in April. And the bond market faces this technical challenge between demand and supply, where the largest provider of demand, the Fed, is expected at some point, right? That's the debate around tapering, to pull back while Treasury supply increases in an environment of funding that tremendous amount of fiscal stimulus. So a lot of what you're seeing isn't necessarily directly this reflection of a view on inflation. Certainly the shape of the curve is steepened. Inflation expectations and tips have increased, but the pace of those increases has certainly slowed as we priced a lot of those changes and expectations in recently.
Jeff, thank you so much. Jeff Rosenberg with us with BlackRock with a 2-year yield of 0.16, comes into 0.1429. 10-year yield of 146 is now in 6 basis points, a 151. Michael McKee, I look at the sense of this, and we got to get to a jobs report on June 3rd, a Fed meeting, which I believe you'll ask a rude question on June 16th. And my answer this morning is Jerome Powell's the smartest guy in the block. He looks like a genius after this, what we've just seen.
He looks pretty good, and the Wall Street economists don't look so good. We have a chart I wanted to put up here quickly because we don't have a lot of time. This is the biggest miss on payrolls ever. And it's because, of course, the scale of the rebounds.
We're in a natural disaster. I'm going to cut him some slack.
Are
you going after Ellen Zentner right now?
We've not seen anybody be this far off since ever. But you can look at the number of jobs created.
What'd you learn from Kashkari? He was talking about, is he going to look at the math or is he going to look at the real economy? From an aerospace engineer, that's a big deal.
I was told there would be no math. I was told there'd be no math. But no, he's making the case that the Fed is right, that Jay Powell is the smartest guy in the room, and they're all smart with him, that the Fed is saying, we're going to wait and see the data. And the data came and validated their view today.
To get to your June 16th question, this massively reemphasizes an ex post analysis. I mean, massively. Like maybe we've never seen in our lifetime. We got to go. Michael McKee, absolutely fabulous, particularly there with President Kashkari. We're going to continue on this historic jobs report. We will look at the administration response. Martin Walsh will join of the Labor Department. El Arian will join from Cambridge. Rick Reeder will join from BlackRock as well, and Michael Collins. This is really something, folks. Stay with us as Global Wall Street reacts to this historic jobs report on Bloomberg Radio and on Bloomberg Television.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now with equity futures up 1/3 and a big bid into the bond market. Let's not waste any time. Let's get straight to the big issue. A monster downside surprise on the payrolls report. This was the reaction of the Minneapolis Fed President, Neil Kashkari.
I feel very good about our policy approach, which is outcome-based monetary policy, which is let's actually allow the labor market to recover. Let's not just forecast that it's going to recover. Let's actually allow the labor market to recover, get back to what we call maximum employment, and get back to 2% inflation, and then we'd be in a position to talk about normalizing monetary policies.
Let's get straight to the panel. BlackRock's Rick Reeder, PGIM's Michael Collins, and Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Guys, let's just start with your initial reaction. Mohammed, 30 minutes ago, the numbers dropped. Your thoughts?
Huge surprise, highly disappointing for the labor market, and then lots of questions. Is it demand, or is it more likely that it is supply? And if it's supply, is it short-term issues that will get corrected quickly, or is it longer-term issues? So big surprise, big disappointment, and lots of unanswered questions.
What's your take, Rick?
Exactly as Mohammed said. There are a few other factors as well. The seasonals clearly are a little screwy here because you take out unseasonal and unseasonal adjusted, you're over 1 million jobs. There's something around the seasonals that are a bit off. It's part of why the bond market's discounting it. The other thing is, though, as Mohammed said, there's some tricky things going on. When you look at it, it's incongruous with what we see in terms of jobs, the jobs hard to fill, the JOLTS job openings data, the ISM surveys on hiring. So, I think why the markets are looking at it saying, gosh, it is a miss. You have to, people are expecting higher numbers. We were expecting higher numbers. But then you've got to take all the noise. And by the way, there's also some factor of people that aren't necessarily ready to go back to work. So anyway, you're supposed to factor it in, but not too much.
Rick, you're talking about how inconsistent this is. Mike Collins, I'd love your response to that. It is almost totally inconsistent with data we've seen elsewhere.
Well, I think it just tells you, John, that the big point here in this data is that you have to take all the data this year with a grain of salt, right? And this is what the Fed's telling us. We've been talking about this with inflation data, but also with the economic data. This pandemic, this crash we went through and this recovery and this big shift from goods demand to services, the reopening, it's creating so much volatility in the data, so much uncertainty, measurement problems, as Rick alluded to, that you really have to just write this year off. The Fed's going to wait a year and then see when the dust settles, where we are in terms of growth, in terms of the labor market, and in terms of inflation.
Mohammed, do you think it's too early to draw conclusions here, too premature? There will be some people saying, and I raised this argument a little bit early this morning, that when you look at the PMI, the ISM, there is clearly not a shortage of demand. Where there is a shortage is in the labor market. There seems to be an execution issue in hiring. What do you think underpins that, Mohammed?
So I think that it is more a supply side issue than the demand side issue, as you say, Jonathan. What underpins it, we don't know. I mean, there will be those arguing that it's the unemployment insurance payments that are keeping people at home. There are those who will argue it is fear. People are not willing to re-engage as yet. Or, God forbid, it could be a skill mismatch. The reality is we don't know. What's key here is that this is inconsistent with what we've seen elsewhere. And that's why it's more a supply issue in my mind than a demand issue. But as to the specific reason, Jonathan, at this point, I really don't know what it is. We have to get a lot more data on this.
If you're just tuning in, you've missed a monster downside surprise on a payrolls report. Breaking down the numbers, I want to cross over to Kaylee Lyons for more. Hey, Kaylee.
Well, the biggest downside surprise ever, John, on record, 266,000. Economists were looking for 1 million. And it isn't just the April number that we have to note, John, but March also getting downwardly revised to 770,000. So this is a big miss. Also, when looking at the unemployment rate, it edged up to 6.1%. As you were just speaking to, John, this miss could allude to just the shortage out there right now, the shortage in the labor market. But clearly, this is something that the Fed is going to be looking closely at. We heard that from Neil Kashkari, the Minneapolis Fed president. But Jerome Powell has said it isn't enough to just get one strong report. We need a string of them in order to restore the Fed's confidence in the economic recovery. This clearly is not that. March getting downwardly revised and a huge miss on payrolls in April, John, 266,000 versus the 1 million economists were expecting, John.
Kaylee, thank you. Rick Reeder, let's turn back to you on this data and how to push it through this market as well. What does this mean for this bond market for the months ahead of us?
So it means a couple of things. I think the interpretation is going to be the Fed can stay on hold longer, which, quite frankly, I don't actually think they need to. I actually don't think that putting liquidity into the system in the front end of the yield curve largely has any correlation with jobs. But clearly, the bond market is going to reflect that they're going to be willing to stay on hold for a while. So we're going to be in a low rate environment for a while. The other thing that is going to continue to accelerate is this dynamic that we overheat and this dynamic that inflation is going to accelerate higher because you've got a Fed that's going to stay on hold longer. Listen, I think a lot of people are going to look at this number and say, gosh, there's a lot of error factor to this. But you're going to have a Fed that's going to keep going. And so that overheat narrative that I hear every call I'm on with clients will continue to persist.
Rick, you said that they shouldn't carry on with this. Do you think they will?
So, I mean, it's pretty clear that they don't want it to move from emergency conditions and don't want to move in terms of tapering down the liquidity. Listen, I mean, we could talk for too long about, the impact that that'll have in terms of quality assets, that you're pressing real rates too low. You're pressing the bid for high quality assets. The fixed income market is so crazy high at this point. It's in the banks are obviously getting huge amounts of deposits that have to be recirculated. Anyway, I think I'm not sure they're going to change the policy, certainly given this number, but I'm not sure the benefit for doing it is where I'm certain it's not worth it, actually.
We'll build on that. Mike Collins, it seems the bond market gets this right now. The 10-year is down just 3 basis points to 154. The 2-year comes in about a basis point. There isn't anything too inconsistent through what I see through the yield curve, 2s out to 30s, from what many people expect from the Fed through the summer and into 22 and 23.
Yeah, we've been saying all along, Jonathan, that we could be in one of these cycles, as Rick said, where the Fed waits so long that by the time they want to start hiking in 3 years, it's too late, that the data's rolling over, right? And I wouldn't totally discount the demand side of today's labor number. Remember, in the first quarter, we basically produced as much stuff as we did before the pandemic with 8.5 million less people, right? Companies, people have figured out how to do more, how to be more productive with less. Profit margins have boomed, earnings have boomed without those 8.5 million people. I think this job growth, there could be some structural, technologically driven elements to this, and maybe it's just the job gains are disappointing as we go through this, and maybe that keeps the Fed on hold longer and gets them stuck at zero ultimately.
What evidence are you seeing of that argument right now, Mike? What would you look for that really demonstrates that? Because that would be an outlier call this morning. That's kind of non-consensus.
Yeah, I mean, you have to, again, just watch the data come in. Everybody's been assuming we're going to get a million, jobs every month. And yeah, there's all these other technical reasons, and people are on the sidelines. A lot of people don't need to work because they're getting all these checks. There's supply shortages. There are some mismatches, as Mohammed said. So there's a lot of uncertainty here. But again, if you wait 6, 12, 18 months, it will be interesting to see how many of those 8.5 million people end up coming back to the labor force, and whether this has been kind of a step function in productivity, a step function in technological usage and advancement that doesn't need as many people to produce the amount of goods we need to produce as a country. So it's going to be this is a very unusual cycle, and this leap we've made in technology usage could change the underlying dynamics of the labor market.
Mohammed, let's talk to the economist in you. Everything that Mike Collins has just said, don't completely discount the demand story that maybe we don't get that 1 million after 1 million after 1 million in the months to come. What's your take on that?
So Mike is saying it is structural, so he's taking it one further step. I said it is the supply side, but it could be short-term, could be long-term. Mike makes the argument it could be long-term, which takes you back to what Rick was saying. If you believe it's on the supply side, then you also have to acknowledge that the Fed can't do much. Running the economy hotter is not going to help at all in terms of the supply side. It helps on the demand side, it doesn't help on the supply side, but your problem is on the supply side. So that is the issue, John, is that this report tells you very little about what's really going on the supply side, but it does tell you, and I agree with Rick, that it will reaffirm the Fed's commitment to doing nothing, not even reducing a little bit its purchases, like the Bank of England did this week, like the Bank of Canada did. It will just keep the Fed where it is for longer, and that raises issues that the Fed itself has pointed to in the financial stability report that was released yesterday.
We're going to talk about that financial stability report in just a moment. Mohammed, I want a final word from you on this. You started the week by saying that the Federal Reserve needed to begin tapering almost immediately. Do you still hold that opinion then after this payrolls report?
I do, because I think that this is a supply issue, not a demand issue, and I really worry about financial instability, and I worry about unanchoring inflationary expectations. So yes, I do.
Mohammed, going to stick with us alongside Mike Collins and Rick Reeder. After a monster downside surprise in a payrolls report, still to come, we'll run you through some of the price action, get you up to speed on what's happening in the bond market, and try and process what this means for broader markets, not just for this morning, but for months to come. From New York City this morning, good morning. For our audience worldwide, the opening bell, 20 minutes away. Equity futures shaping up as follows on the S&P 500. On the S&P this morning, we advanced 10 points, up 0.25%. It's almost as if the payrolls report an hour ago, for the equity market at least, never happened. This is Bloomberg.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
If we're wrong, if these inflation surprises are not transitory but end up being more persistent, we have the tools to deal with that. What we are doing right now is providing a lot of support. I don't see any reason right now to change something that is working and providing support to the financial system and to the economy.
That's the take from the Minneapolis Fed President Neil Kashkari. Bloomberg's international economics and policy correspondent Mike McKee sitting down with Neil about an hour ago. Mike, we've got to start at the top, haven't we? Your take.
Obviously, we thought we could extrapolate from what happened in March, a very rapid reopening of the economy, and we thought wrong. The forecasts were all off, and as a matter of fact, the biggest miss in history in terms of jobs. Can't really blame Wall Street for that because the magnitude of the hole is so great. But it does shows us that it's not going to be linear and quick getting back to where we were before the pandemic. You still have people who are afraid to go back to work because they're not vaccinated or because they think all the other people around them might not be. You've got parents who are stuck with children at home because schools haven't reopened, so they can't go back to work. We do have this issue of, in some states, maybe people are collecting more in unemployment than they go back. And then obviously, people who want to go back to certain jobs, those jobs are gone. So it's going to take a while to work all this out.
Some of the Fed officials, of course, will use this as evidence that they need to wait. And it comes within 24 hours of putting out this quote from Governor Brainerd, and I want to read it to our audience. The combination of stretched valuations with very high levels of corporate indebtedness bear watching because of the potential to amplify the effects of a repricing event. I found these comments yesterday, Mike, to be as strange as many other people found them too, as if risk appetite was this thing that was out there that had nothing to do with them and that they didn't support. What was your reaction to that?
Well, it was kind of interesting. I think the problem is people focused on that quote from Lael Brainerd, talking about a certain class of assets and a certain set of assumptions in terms of Fed liquidity. The Fed report also said, though, vulnerabilities from both business and household debt have declined, reflecting a slower pace of business borrowing and an improvement in earnings, as well as government programs that have supported business and household incomes. So they're saying the system overall is okay, but there are some stretched valuations. Now the question is, who's going to be right? Are we going to see the stretched valuations snap like a rubber band and hurt the overall economy?
Yep.
Lael Brainerd warning a little bit about that, but Neil Kashkari today telling us he didn't think it was that big a problem, and that's Wall Street's fault. But they do seem to have gone from taking away the punch bowl to being the bartender.
I have to say, I wasn't surprised that was Neil Kashkari's response to that particular question. Mike is going to catch up. And that bartender reference, SocGen's Kick Juice said the following: the barman suggested another drink and then warned of exuberance. With us is BlackRock's Rick Reeder, PGIM's Mike Collins, and Mohammed Al-Erin of Queen's College. Rick, you became a little bit more cautious about a month or so ago when you and I last caught up. Is that still your position right now?
Yeah, so, I mean, we definitely run in a lot of cash in the portfolios. We are, some of this exuberance argument and this overheating does give you a bit of pause. I mean, you still, particularly people have gotten more comfortable, so volatility has come down. You could still run a long equity beta position, using some options to keep some protection in the portfolio. I would argue interest rates aren't a great hedge today. They'll probably be a bit better over the coming weeks. But yeah, we're still. I mean, I still think equities are going higher. That being said, because you can use some options to protect some downside. I am a bit concerned. We hear Lael Brainerd say it. When the Fed puts $120 billion a month into the system, and then you get the Treasury pay down, the TGA drawdown, that puts another, depending on timing of how you look at another $500-600 billion over a quarter into the system. There's no question why the money's got to go somewhere, and this is part of why that exuberance. It's not because people want to buy at levels they're buying at. It's because there's just too much liquidity floating around the system today.
Rick, when you say you're running a lot of cash, how much cash?
We run a lot of different portfolios, but we're running, depending on some of our active tactical portfolios, some are a bit higher, mid-teens type of cash. It's the quality assets that we talked about that trade at zero spread or real rates in high quality assets that are severely negative. When you think about what they're doing for your portfolio, the answer is little other than downside risk. So we just cut all that out, rather sit in cash, and then take where we think there's upside convexity, take our risk there.
Mohammed, what's your response to that?
So it makes total sense. If you look at the world that these distortions have created, it's hard to be confident about return generation, and it's hard to be confident about risk mitigation. So, I really feel for people out there. I thought what was really interesting, if I may, Jonathan, was your interview with Leon Cooperman. He said, I'm a fully invested bear. That is such a powerful sentence, and it captures a lot of people feeling tactically very comfortable with taking on risks, but strategically and structurally and secularly very uncomfortable. Now, that's wonderful as the ride goes along, but if ever conventional wisdom changes, you can see why the Fed is warning about a repricing. Because this notion of being a fully invested bear is something that I suspect a lot of people are.
Well, I'm pleased you reintroduced that phrase, because I'm going to use it on Mike Collins now. Mike, would you characterize yourself a fully invested bear?
No, that is a very apt phrase, because you look at the fundamentals, as Mohammed said, I mean, they're really good, right? Credit fundamentals are going to be as strong this year or improve as much this year as we've seen. I mean, in high yield, we're getting a lot more upgrades than downgrades. You're going to get more rising stars and fallen angels. High yield spreads are probably going to be tighter by the end of this year. So it's really a little too early to fade this improvement in fundamentals. But that being said, we have started to reduce risk. The way we think about it is not in cash, but we have a risk budget for credit. We were running at 100% at the beginning of the year. Today, we're at 75%. And it's really for two reasons. When you look at the top-down things, this financial stability risk. To me, there's two big policy risks. One, the Fed sits at zero forever, and this thing runs hot, and you get these big bubbles and busts. Two, they lose patience and they start hiking sooner than expected, and the curve flattens. In either of those cases, the curve flattens and it's a risk off. But from the bottom up, as Rick pointed out, as we go from sector to sector, bond by bond, there are a lot more things to sell than there are to buy. So that bottom up decision is really what drives our risk taking. And there are a lot of bonds, credit products that look fully valued to us.
I'm going to talk with you and Rick a little bit later about the credit story. Mohammed, before you go, we've got to catch up about this cycle call that Mike Collins and PGIM and the team are having at the moment, which is potentially shorter and hotter. This morning, at least, you don't see the heat. Do you think it's too premature to make a cycle call?
Yeah, I think there's a lot of uncertainties out there, but I do sympathize with what Mike said, which is that policy risk has migrated up in terms of things to look at. And it's no longer favorable policy risk. We've come from a period where policy risk has been very favorable because of the amount of liquidity injected, as Rick pointed out. Now there's policy interruption risk, which is a completely different type of risk. And that is migrating up, and it's going to attract a lot more attention as people look to how to invest over the cycle.
Mohammed, we spent a lot of time talking about policy risk and talking about the Federal Reserve. In about 20 minutes, I'll catch up with Secretary Walsh, the Labour Secretary in this administration. If you had a question for the administration right now, given what we've just seen this morning, what would it be?
It would be, why is it that we can't match what seems to be higher demand for labor with actual job gains? What's interrupting that very important transmission mechanism from demand to supply of labor?
Execution risk has been a story in earnings season for the last couple of weeks, and seemingly a story in the labour market maybe as well. Mohammed, always great to catch up with you, sir. I know you've got to run. Mohammed Al-Arian there. Rick Reeder and Michael Collins are going to stick with us through the opening bell. We'll have a chat about these markets and about credit too. We've got to work our way through this labour market. A monster downside surprise. If you look at all the other data points in America right now, it signals really strong demand. Why couldn't we meet that in a much, much bigger way than we did in the April payrolls report? Coming up, President President Biden continuing to push for tax hikes to pay for social spending, setting up a battle with Republicans. That conversation is just around the corner with Rick Reeder and Mike Collins. As we count you down to the opening bell, your equity market set up as follows. In New York City, 7 minutes away from the opening bell, futures through 4,200 and up 9 points on the S&P 500. We advance 0.2%. In the bond market, almost a round trip on a 10-year yield. A break of 150 down, and then a breakthrough 150 the other way. 154 and down 2 basis points on the day. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Five minutes away from the opening bell in New York City. Equity futures positive 0.2%. You were looking for 1 million. You got 266,000. A big downside surprise on a payrolls report. Going into the opening bell, let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with RBC, upgrading Viacom CBS to outperform. $52 price target. The analyst highlighting global streaming tailwinds and a compelling risk reward following the stock's recent declines. Their stock is up by a little more than 1%. Your second call from Jefferies, upgrading Tilray to a buy from an underperform $23 price target. The analyst expecting further market share gains stemming from its recent merger with Afria. That stock is up by more than 7%. And finally, Stifel upgrading Etsy to a buy with a 205 price target. The analyst recommending investors buy the dip following the stock's 15% post-earnings decline. We advance there by 3%. Coming up, financials moving lower, tech jumping after a monster payrolls miss. That conversation still ahead with BlackRock's Rick Reeder and PGIM's Mike Collins. From New York City, this is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Monday, a Bloomberg exclusive conversation. Dallas Fed President Robert Kaplan joins Balance of Power live at noon Eastern on Bloomberg Television and Radio.
Well, that was a surprise. Going into the opening bell, equity futures look like this on the S&P 500. We advanced just a little bit on the S&P. We are higher by 9 points, up about 0.2%. On the Nasdaq, up 0.9% after a big downside surprise on a payrolls report, which for some of you means a Fed that stays on hold on both its balance sheet and rates for a long time. It's one payrolls report. Here's the bond market. We look like this on a 10-year. Yields in America are lower by 2 basis points. A brief break of 150, right now 154.52. In the FX market, euro dollar back through 121, 121.05, and up a third of 1%. And crude, we take some weight off the WTI rally, 64.22. We're down on the session by about 0.75%. Got to get you some movers at the market desk. Here's Abby.
John, let's keep it super simple and stick with this morning's big story, and that is that monster miss in payrolls and the huge move in yields. And even though yields are well off the lows, in fact, the 210 now only down less than 1 bip, still influencing certain sectors. We have that outperformance for the NASDAQ 100. Not surprisingly, big tech is outperforming. Your Apples, your Microsofts, your Amazons, and your Facebooks are higher, although look at that, well off the highs. If we take a look at the banks, which before were plunging, they are still sharply lower, down more than 1.5%. So it's interesting to see that the directional moves have stuck there, John, but the tech not holding on to the gains in the way that banks are holding on to the losses. Again, big moves here off of that monster payrolls miss.
A minute into the session, the banks are down, the equity market's doing okay with the cross-asset price action. Here's Kaylee.
Well, John, the equity market doing okay, but right now the S&P 500 up just about a point, less than 0.1%, well off the levels we saw on the back of the number. That knee-jerk reaction initially was equities much higher. The market really trying to digest what this massive miss is actually going to mean for Fed policy. Are we going to get any kind of tightening anytime soon, or does this report just throw cold water on that thesis entirely? And in the bond market, we also saw a very sharp knee-jerk reaction. That was yields lower. We broke below 1.5% on the 10-year Treasury yield and then quickly reversed that. Now we're down just a measly 2 basis points to 1.55%. I would point to some commentary from Sebastian Boyd, one of our columnists on the MLive blog, and he says that initial reaction was actually right. The complacency around this recovery has been shaken, and at the end of the day, this doesn't change what just happened. What just happened is an indication that it's going to be good for bonds and bad for the dollar, and it is still bad for the dollar this morning, John. The Bloomberg Dollar Spot Index is weaker by about 0.25% at this point, and as you said, euro dollar back through 121, though we are off the earlier highs. Finally, John, what all this points to is just how hard it is to wrap your head around anything when it comes to this recovery, because this is a recession unlike any other, a recovery unlike any other, and there is still so much unknown. Forecasting is incredibly hard right now, and that is why we saw a record miss on non-farm payrolls, John.
Kelly, thank you. About 2 minutes and 40 seconds into the session there, the S&P 500 unchanged. The winners of the week going into Friday, now the losers of the session. The financials are down 0.9%. The energy off by more than 1%. The energy sector suffering there. Information technology top of the pile up by 0.6%. Healthcare too up by 0.54%. Still with us, I'm pleased to say, is BlackRock's Rick Reeder and PGIM's Mike Collins. Rick, can you build on that? There's so much dispersion out there at the moment. The range of estimates are super wide going into reports like the one we got this morning. How difficult is it to forecast month by month at the moment from where you're sitting?
I mean, Jonathan, that is exactly the right point. I mean, the reason why the market's actually, the 30-year Treasury is actually higher in yield on the day now. I mean, the reason why, I mean, the markets dismiss when you get these major aberrational moves. I mean, you have to factor it in. Listen, I think when you go through it, it is surprising. I do think it's more of you can't actually find the people in those jobs that are out there. But the markets, you have to smooth out. I mean, I've always been a big believer. If you look at the 3-month moving averages, I have to say that over my long career, that picking one employment number, I've learned that there are better ways to generate